stunned by what the Red Sox gave up for Adley Rutschman, said one evaluator from another org. I'm absolutely dumbfounded by this. This is literally one of the most ridiculous trades I've seen in 30 years. Okay.
Unless they sign him to an extension.
Even without that, what if he puts him over the top the next 2 years? This is one of the best catchers in the sport. Is Adley Rutschman at this point being unfairly evaluated because he's not a super duper star? He's just right now an all-star?
Yes. Okay. Because he was 1-1. Stop with that. Whoever's doing that.
Ridiculous trades ever. Like, you would think, if this is one of the most ridiculous trades in the last 30 years, I would, like, to me, I'm getting a player who I don't even think is going to play. That would be like, I don't know, this might not be the best example, but like Anthony Rendon doesn't want to play and you trade for him. Like, that would be a ridiculous trade. Adley Rutschman is going to be a big-time contributor for you as long as he's healthy.
You know, it's ridiculous.
You're not offended by that? Someone saying this is one of the most ridiculous trades in the last 30 years. What?
It's ridiculous because that executive would never do it themselves. That executive would never say, you know what? We're going to push because we have a clear gaping hole at the catching position right now that we want to upgrade.
I know you guys aren't
gaping hole at the catching position right now that we want to upgrade, and we can upgrade it with the second best, voted on by fans and players. He was an all-star. You couldn't get Shea Langoliers, so you.
All right, so we'll leave that alone. Look a-yonder coming down the railroad track. Hey, look a-yonder coming down the railroad track. It's the Orange Blossom Special, bringing my baby back. All right, so we got ourselves some prices at the close. Nixie pops up here. I don't remember why I was talking about that. Maybe it was somebody earlier. But remember, a good person, a good friend of me, brought up Nixie a while ago here. I think it was $1.80, $1.90. There was all a buzz about it's going to have a data center and all this. But remember, when you read the press releases and when they talk about markets in general rather than specifically, it's not really a good sign. And that stock now is 55 cents, 0.5582. It closed at 55.82. That's where it closed. Railtown closed at 23.28, actually in the green, 0.0028. Decent volume, 80,000 shares on the day. Now, Finger, I'm disappointed to point out, was down almost 6 cents today, 0.059, down 21.85, and the volume was just huge, 40 million shares. So I think that should probably remove from many of you who are still clinging to the idea of a short squeeze. That, my opinion, 40 million shares should remove that from your list. But I don't know. There's all this manipulation that goes on. You could always have a fire up and then a downturn. I can't predict those kind of things. But for the first time, I cannot tell you that you can exchange 1 share of Finger Motion for 1 share of Railtown. However, I would still do it. Maybe I can tell you, you can exchange 5 shares. I'm doing it off the top of my head. 5 shares of Finger for 4 shares of Railtown. Railtown still has it in it. Railtown has the giddy up and go that can not only make whatever you lost in Finger, if you get approximately, I'll try to get the right ratio. You get 21.5 cents for Finger Motion. And if you pay 24 cents for Railtown, it might be better than I thought. Maybe if you sell 10 shares of Finger, ten times 0.215. What's that number? That's crazy. 10 times 0.215. Yeah. And then you pay 24 cents. Yeah, it's about 9 shares. It's, depending. It's penny. It's a fraction of pennies underneath. But basically, now you can sell 10 shares of Finger and receive 9 shares of Railtown. I strongly, it's opinion, of course. I can't give you specific financial advice. I strongly recommend you do it. Finger Motion ain't going anywhere but down and out, in my judgment. Railtown, as soon as the description changes, as soon as I think we can count out, maybe we can talk about it, maybe Ward can help me talk about it, but I think we can count out 4, 5, 6 different potential revenue focuses for Railtown in what's going to be $1 trillion a year spending on software, not on data centers, on software over the next many, many years. And all Railtown has to get is a piece of that. I don't know what you paid for Finger, but let's say you paid the highest recently. Well, let's say you paid $17 for Finger. I don't think many of you did, but Railtown can make that money back for you. Finger's not going to make it back for you. But you got to do it while there's still something in the corpus of Finger. Finger is probably headed as close to zero as any other company out there. And I said that, I don't know, whenever I got upset on live when Martin signed that deal. And I did some research on it. I was going to publish something predicting in writing lower prices. I didn't do that I didn't want to pick a fight or go against very good shareholders, really good shareholders, and against Ham. That's not my motive at all. So I didn't try to, go out and hammer it. But I have made it clear here now for at least a year and a half, that a switch into Railtown is what I would do. I don't blame you. I called for a switch of GTII into Logic. It was a good call on GTII. It wasn't particularly good call on Logic. I think the key difference is unreliable CEOs. I think Brent Sun and Mark Shen, as it turns out, are unreliable. You can't rely on them not to sign a crappy deal. And I think the evidence is out there. But we'll go over it again today. I haven't finished my project with you. We've got two more little things to go through. But what we're learning, and I'm being reminded of, is that the Securities Acts of 1933 and 1934 were a compromise. And it was all about disclosure, not about whether retail or institutions made a bad deal, made a bad bargain. So Lynn Partners or Waddell or Yorkville or the Kramers, they can create the most filthy, toxic, stinking, radioactive document in the world. And as long as they disclose it somewhere, apparently that's enough for the courts. I would argue it's not enough, but so far the courts feel like that's all they have to do. And as long as they can get a CEO like Brent Sun to sign it, or Peter Boards, I'm not sure Peter Boards signed it in the case of, I can't remember if it was the board. I think it was Brent that signed that one. Anyway, or get Martin Shen to sign it for Finger. It's just a nightmare. Now, one thing which I've shown you here, and we'll do it more, not tonight, we'll do it a little bit more. CEOs can be proactive about using the financing from what I would call a hard money lender, a dangerous hard money lender, but they can also change the wording in the documents. They can be proactive, particularly if they're working from a position of strength and they have a strategy. It's not, in fact, every company that goes down. But we'll get to that. So anyway, you still have a chance to, I mean, it's pretty close to 1-for-1. Sell 10 shares of Finger, buy 1 share of Railtown, lock in your losses. You still have enough corpus in that play. You're very fortunate if you're a shareholder of Finger. There is a stock that's being suppressed by the non-thinking machines. Railtown is being suppressed, and it's so suppressed, you can switch horses, switch trains, and get a heck of a ride and get all, I think you're going to get, it's an opinion, but I think you're going to get all your money back in Finger Motion and much more. Even at selling 10 shares of Finger to get 9 shares of Railtown. But if you wait till Finger's 5 cents, Railtown could be $2 at that point. You've got to act now. If you're pissed off, you're upset about Finger Motion, you're listening on those calls, it was going to change your life, life-changing money. Well, your life can get changed both ways when it comes to money. And you have an opportunity if you can just act. I know your heart is low, you're pissed off, you're hurt. Sell your Finger. This is opinion. It's not advice, because I can't give personal advice because I don't know you. I don't have that relationship. But sell the Finger, buy Railtown, and get away from it. Finally, you still have time. Yes, it was better. Yes, a year ago, you could have done 12 shares of Railtown for 1 share of Finger. Yes, the beginning of this year, yeah, I think it was 4 or 5 shares. And yes, just as recently as a couple of weeks ago, it was maybe 1.5 shares. But right now, it is what it is. Take advantage of it. Railtown can go from 24 cents to 2.40 and then $24 a share and just be getting going. Finger motion is just going to wallow in the mire. Why? Because Martin Shen signed a really toxic, crappy deal. And we're going to find out today. As long as he says he looked at all alternatives, I would submit that if Martin had come to us, come to his investors, he could have gotten a better deal than that. But it ain't pretty, and you have a way out. But anyway, I'm not gonna hammer on that. You have an option. You're very lucky. If you're trapped in finger, you can still get out and still rescue your account. It's amazing to me. And it's just because this ongoing I don't know what to call it. Minting, mining, fleecing of retail is allowed. And so you have that option. Finger, and I'm not picking, I'm trying to just for anybody that's on the fence. Finger does about 25 million a year at 3% margin, and they lose money. Their burn rate is very high. Railtown probably has just turned to revenues. We'll find out. But frankly, Railtown doesn't have much in the way of revenues yet. But Railtown, when it gets going and they say all aboard and they throw the coal in the engine, Railtown's 25 million a year in revenue is going to be a starting projection. To me, it's far more likely Railtown will be 250 million in forward projected revenues. And that could happen by the end of this year. And ultimately, Railtown could be doing, I know it's, if you're in finger, it's going to stretch your mind. But as long as there's been hundreds of billions, if not trillions, invested in large language models and data centers, the only thing that makes it work are these orchestration layers. And Railtown's not the only one, but it's unique. It's agnostic to which data center. So let's call it the conductor cloud, allows usage across all data centers. And it's a huge market. And it can keep the part sovereign that needs to be sovereign. It can direct the electrons. We are the joy boys of radio. We chase electrons to and fro. It can direct the agents, the tokens, the spend to where it needs to go. Real time, nanosecond. Nobody else can do that. Agnostic. Well, I'll tell you, I'll put it this way. There isn't a public company that I've been able to find that you can invest in. And Railtown got started by, I think, 3 geniuses. And if I'm leaving someone out, it's just my brain power. It's not intentional. But you had Dr. Rambling Jack Elliott. You had Marwan Haddad, and you had Corey Brandolini. And they put their money up. They acted. They had an idea, and they took action, just like you should be doing tomorrow morning. You got to act. You got to, sometimes you just have to act and control the deal and get her done. You can't think about it. But they did that probably 6-7 years ago, losing track of time. And I think, in fairness, they were building a solution, and many solutions, probably several, for an area in software that no one had ever addressed before. But because of their experience in software, they saw what they wanted to do. One of them said, well, why don't we're early, but why don't we build something that's ready? I'm starting to believe they already knew about agentic AI. But why don't we build something that's ready for when everybody goes from SDK built software to all software has to be replaced using ADKs, whatever, people have a slightly different definition of the agentic development kit, AI software development kit, but you get the idea. You go from all the software that's ever been built, all the applications that you use on your phone have all been built with SDK, software development kit. They all have to be replaced using agentic development or AI software development kits, ADKs, all of it. All of it. It's huge. And these guys were first. But when they started, no one understood it. Everybody was like me. They're like, huh? Well, that's nice. But I kept at it. And I think what I was able to see, although I haven't been correct about timing, and a lot of the information I thought I had turned out to be completely mistimed and in many cases just wrong. But I have experienced Wall Street and trends. That's all I've ever experienced. And the monies that I projected would go to AI about a year and 2 months ago, it happened in spades, and it's not over with. We're having a correction. There's people out there that'll say that we're going to rally right back. I would point out to you, I think there's some companies in trouble, like Oracle. I think that Wall Street, big guys like Leon Cooperman and Fink and Black and Schwartz and I don't know, these big pools of money. They went out and bought insurance companies because the regulations were, no one was looking, and the regulations are pretty much fragmented state by state. And then they've pitched these deals to retail investors. Hey, put your money up. We'll bump the principal amount up by 25% out of the gate. So the person selling it gets commission as high as 10%. So if somebody puts 10 million in that product, safe, it's insurance, and you're getting a bump of 25%, the person gets a commission. I think they get commission on the bumped up amount, but it may just be on the 10 million. So if you put 10 million in, the advisor gets $1 million right up front. So what does that mean? That means that the investor has fewer than $9 million because probably the firm takes some money too, and the insurance firm takes some money. So there's fewer than $9 million going to back that 125 promised principal. And where's that 9 million going? It's going to take the risk off of Leon Black's Apollo, take the risk off of BlackRock, take the risk off of you name the group, that then lend money to the data centers. And the risk is reinsured offshore. Good luck if any of these insurance companies collapse. There's not any money to bail out. And it's not the federal government's responsibility. I think it's the states, up to 250,000 or something per contract. Good luck. Retail's going to be wiped out. Where I think the biggest scary part that's going to come out of the blue is private credit. And these guys out of New York and these big pools of fund, they know better than risk their own capital. They're sitting on hundreds, even trillions of dollars. They don't risk their own capital. They risk American investors' capital in this clever insurance wrapper. Well, nightmare. So you put up $10 million. Your advisor takes $1 million. The insurance company takes something. The firm takes something. You probably got 8.5, maybe 9 million going at it. You can't get out without paying that. It'll slowly work its way down over 10 or 15 years. And then the person that got you in it is going to collect 0.5 or 1%, maybe even 1.5%, I believe, of the total amount, the 12,500,000, as a trail for his wise recommendation that you tie up your money bailing out Apollo or BlackRock or Blackstone or Blue Eyes or Black Eyes, or, it's the next thing that will come as a surprise, and it'll be, oh, we didn't know. Well, they know. There's no way that these 125%, the 25% bond, by the time the 10 or 15 years go by, if it pays out, it might be a 2 or 3 or 4% yield. And that does not hedge against the collapse in the dollar that's coming, the change in oil prices. It's just a bad deal. But I forgot why I got off on that. On the data centers, I think there's going to be a crisis for Oracle and some of these overstretched. If I had to pick one, I think it's OpenAI, but it might be Microsoft too. We won't know till it's all over with. But in that environment of fewer GPUs being built and literally panic on, are these data centers that are already built going to make a profit? Wall Street's money is going to go to the orchestration layer, right where Railtown's sitting, And I think Railtown's the meter. So I think as that Wall Street crisis goes on, the data center crisis rolling through the insurance wrapper business, and it becomes the big scandal of 2026 or 7. It'll be in 2008. It was the slicing and dicing of mortgages. I think this time it's going to be that. I could be wrong. You know, it'll be something out of the blue. But it's going to make rail. Now, it could diminish these huge multiples in everything AI. But remember, Railtown and others doing this are getting, and others like Apple or Microsoft or Google, they have to finance data centers and they have other spending. Railtown has no more spending to do. They spent their money. They spent their 7 years. They have nothing else to spend. Now they will spend. They will. They're doing the service part of getting companies to implement AI right now, just like Microsoft had to do 3 decades ago, and Apple did a bit of it for the App Store. But it'll lead to product-led soon enough. So there'll be some spending. They're spending $500,000 on this, whatever it is, WSI. You can look it up. It was announced in July. And I think it's going to be very successful. But Railtown's profit margins are 100% or as close to it as possible, 85, 90, 95%. Finger motions are less than 3%. And there is no big wave of institutional money coming for top-up minutes, particularly in China. It just ain't happening. But institutional money is pouring. And I think after the Labor Day break, you're going to see it. It's going to pour into this orchestration layer. Pour. They all need it. Now, you know, there's arguments, will large language models survive? Is it going to go to distributed models, small language models, I guess it might end up being called? They're going to still need Railtown. They're going to still need that orchestration layer. What happened is these guys saw and acted early, but nobody knew what they were talking about. And so they raised some money. They went public in Canada. And of course, this grinding machine of stealing money, I don't care how many people make apologies for the system, it should be fixed. Well, it's under debate and, you know, it might have bad, it should be fixed. But no one's doing it because it's so lucrative. But Railtown then got to the point they needed to raise more money, so they listed on the over-the-counter, thinking they'd come down here to raise money. Thank God they never did. Otherwise, they'd be in the same position, maybe, depending on what they signed, with same position as MMAT, which I think had great products. What changed it for Railtown, oddly, was ChatGPT hit the market with a thunderclap. And all of a sudden, everyone, instead of saying, so what are you doing? They went, oh, you're doing AI. I heard about it on TV. I heard about AI and OpenAI, and I'm using it. And wow, that's what you're doing? And all of a sudden, they didn't need to go. They didn't need to go to the American market. So Railtown is trading on the over-the-counter market. It's subject to those computers because last year they announced they were in an LOI, an MOU first, and going to an LOI to acquire AIP. Well, those are just the perfect words for these computers, these sharks. They read all the news. It's all by computer. It's by AI. And they see those words. Oh, it's not signed yet? Well, we can crush the stock price. And maybe if the two companies continue to work together, they're going through a known criminal aider. In my opinion, it's criminal. But if you talk to these high-priced attorneys, well, it's allowed and the regulators can't keep up and we disclosed it. I'm so tired of, you can see what they do. Well, Railtown didn't have to go take any of that financing, but just because they didn't take financing, the short selling and the crushing started 14 months ago. Now, in fairness, why is a company that's advertised, it's not advertised. If you look it up, I mean, I've shown it to you, but if you look up Railtown right now, you go to, let's see, OTC markets or ORC markets if you can't type. And you write RLAIF and you click on Railtown Technologies on over OTC markets and you hit company profile. This is what the computers see. This is fascinating. Railtown AI Technologies is in the business of developing a software as a service that's in the toilet right now, artificial intelligence solution that helps software development teams detect, analyze, and fix errors quickly in their development projects. The platform allows for real-time exception monitoring and alerting, which permits developers, team managers, and executives to quickly locate, understand, and correct errors in their software development projects and their root causes, thereby preventing system and application downtimes. And the screening computers don't see it. There's literally 5,000 or 10,000 of these SaaS companies out there. The screening computers don't see it. Let's just pick one. Let's pick Vercel. I think that's a competitor. I don't think it's public. But let's go to Vercel AI. Maybe that's it. I don't know if I'm on the right place. Let's see what it says about itself. The Vercel describes itself as the end-to-end platform for AI workloads. It's an AI gateway. Switch between AI models without needing to manage API keys, rate limits, or provider accounts. Read the documents. Fluid compute. I don't know. It's to me, it's not that much better, but it's not a SaaS company trading SaaS developer to developer. It's just because I don't. Here's what Vercel is: the home of AI apps. When cutting-edge AI development requires more than just a platform, Vercel stands out, delivering unprecedented tools and performance. Well, that's not. I mean, but from LLMs to text to image, commence your AI projects with a running start. Slack agent, chatbox, trusted by. They got all the names. Agent stack, core platform, tools. They got it all. But I can't find an about the company. Let's see what it says. It has a lot of positions. That's my position. If you don't like it, I have others. Anyway, let me see if I can find a description. What is Vercel? Stupid thing. Vercel AI. Let's just see what Google says. Vercel AI is a suite of tools and cloud infrastructure designed to help developers build, root, and scale artificial intelligence applications and autonomous agents. Its core offerings include the open source AI SDK, the multi-modal AI gateway, and secure execution environments like Vercel Sandbox. So, what is Vercel? Vercel AI value. $9.3 billion. 9.3 billion. 9.3 billion. But this is what Railtown has, but it's not out there. Let's see what they say about, what's another one? I can't think of another one except for bloodied LangChain. Nothing comes to my head. So what is LangChain? I misspelled it. LangChain is an open source development framework designed to simplify the creation of applications using large language models. It provides standardized modular architecture to connect LLMs with external data sources, computation engines, software APIs, transforming static models into dynamic context-aware applications. They don't talk about SDK, helping developer teams work with SDKs and software tools and make sure everybody feels good. What is LangChain worth? I personally think that Railtown's better than Vercel and LangChain, but the last value on LangChain is 1.25 billion, but that's a year ago. It's a year ago. Sequoia. If Railtown just got to LangChain's value of a year ago, $5 a share. $5 a share. So anyway, just to finish my point, we got lucky because they were trying to raise money publicly, and the grind continues because Canaccord Genuity will step right in and facilitate a crappy financing deal once the stock's driven down and the merger goes through and they need capital and you got a destroyed company. That did not happen. Or they'll destroy the stock price and it'll break up the merger, and then the company keeps going down because everyone bought it for the merger. And that didn't happen. But that's the strategy of clients that use Canaccord Genuity. And nobody can say it, but that's what they do. Well, we got lucky. Railtown didn't sign any deal like that. And in fact, they got all the financing they needed, albeit at a low price, from the BlackBerry guys. So we got everything. The stars have aligned. The storm, perfect storm. Maybe we just got lucky. I had lucky, and then he died, the poor guy. I had lucky. All right, let's go through some of your comments. So just remember, tomorrow morning, you can exchange 10 shares of Finger Motion for 9 shares of Railtown. And it's my strong opinion you should do it. Because I'd like you to be here and make money, and not only make money, go in the green and be in a company that's going to beat the system. It looks like roughly 20% of these companies have a plan and get through it and make it. So that's where we want to be. All right, let's go to the top. Pat M. Hi, gang. Hey, Pat M. KYP. KYP's number 2. Hey, Billy, how are you? I'm good. How are you, KYP? I hope it's not hot up there in Brooklyn. It's hot down here. Anyway, it doesn't matter. I had to do a lot of shuttling today. It's very hot. Getting documents and signatures and all this thing. We had really nice rain yesterday, but for some reason it's even more humid today. I hope it's not like that for you up in New York. Sung Hee, good afternoon, Sung Hee. Good afternoon, Fast Eddie. You were not so fast today. You came in 4th, but that's still pretty good. How are you? And Harbison, hello, William and crew. Donna M is here. Hello, everyone. Hey, Pat M, glad to see you here. We're all glad to see Pat M and Donna M. M and M. Ward Richardson. Good afternoon, William and RT crew. That's correct. There will be trillions of dollars spent on software. Exactly. Jack Hamilton. Good afternoon, Mr. William, and to all. Jack Hamilton. Hey, Donna. Oh, Donna. Jack Hamilton. Jack Hamilton buys 80 more shares. Oh, I didn't show everyone. Over the weekend, we didn't change this that I remember. So we're at 23,724,613 shares of Railtown. Pretty impressive. Pretty impressive. That's great, Jack. I love it. I love it. Ward would tell you that, maybe he'd say it this way, but everything over 100,000 is bonus shares. Jack Hamilton, funds are low at the moment, but adding with pennies. What's that joke about funds are low? There's a joke, funds are low. I can't remember it. Yeah, I wish I could add, I wish, never mind. I wish a lot of things, but I think it's great that you're adding with pennies. Ward Richardson. Wiser AI Systems and Cinchi partnered with AIP in the last 3 weeks. That is not a coincidence. And I see this as a strategic move with RT. You bundle Wiser, Cinchi, and RT, all three, I guess, disruptive stacks, and you have a Ward Richardson, highly sophisticated next generation enterprise software suite. I agree. And more than that, one of the explanations that could be, no one's told me this, but it could be that the reason the companies had to be so quiet is that the government funding, which requires, by the way, that digital team to apply, but government funding may be coming maybe to put those three together, and then you have a platform, and perhaps it beefs up the conductor platform, the conductor cloud. I don't know. We'll find out. We'll find out. Donna M. Hello, Jack. Adding is adding. I added 13 shares. Wow. Pretty possum. Pretty possum. Ward Richardson, the story here with RT keeps evolving. Yes, I agree. But I think yes, that's the right word. But I think it's also the whole market where they are is evolving. And I think those evolutions are not at a Darwinian pace. I think they're at a Peter Parker swallowed a radioactive pill pace, or whatever. It's very rapid. It's very rapid. Jack Hamilton, right on, Donna. Is Pluto a planet? Well, could be. But if you call it a planet, there's probably 10 more. I think there's a planet out there. They just assumed it was Pluto that was making all those orbits behave with the little, not gyrations is the wrong word, but the little pulls, tugs and pulls out there. I think there's a bigger body out there they just haven't found. Railtown could hit high prices, real high. Rail high even. They could be rail high prices. Could. I think that will. The risk in Railtown, I think, is the same risk in any stock. The 44-year secular bull market is going to come to a close at some point. My opinion, unfortunately, look, I don't think it's his fault where the United States is with its technological prowess and its war strength and its bloated military. And, I think the Soviets and the Iranians and the other countries China have been much wiser in their spending. But anyway, what's happening is it's, one thing you can say about Trump, he gets impatient and he'd rather blow up the conference room and get something done and let's move on and have endless meetings in Canada. Can you imagine Donald Trump up in Canada? Oh my gosh. The meetings he'd have. He would lose his cool. But in New York City, it's perfect. He can be brash and work hard. He always worked hard and make things happen. And anyway, I think as we're seeing, things are going to be changing for us. And one of the things is the bull market could be imperiled. That's something that could affect Railtown in terms of multiples. But the market really right now is held up by a lot of reinvesting and a lot of automatic investing and a lot of money being directed into by people that might as well be insurance agents. You go to a brokerage firm and they say, well, why don't you put it in this fund or put it in this wrapper and see this glossy booklet? You could look like that, and maybe your kids could be, your kids will marry and have grandchildren, and it's all going to work out. Well, all the money just pours into these pools of money, and the money goes into the same stocks, and it feeds on itself. I argue there's no price discovery in the stocks under $5, but I would argue with you there's very little real price discovery in the private equity markets. It's all rigged. And then in the 6 to 8 to 10 stocks everybody invests in, there's no price discovery. And I would argue with all of you that you're going to find out that one of the most mispriced assets in the world is oil and gasoline. But it's been mispriced for a long time. So we figure it can continue to be. But anyway, the threat to Railtown's price rally, the how high it can go, it's going to go up and it's going to be high. But one of the threats is the end of the secular bull market. Of course, in any panic, everything will be thrown out with the bathwater, briefly, temporarily. The other threat is AI gets out of favor. Well, I'm trying to tell everyone here, Railtown isn't really, of course it's AI, but it's not the AI they're talking about. They're talking about the data centers, and they're talking about the big 7 or 8 or 9 or 12 companies. And there's still going to be huge cash flows, huge revenues directed to building out agentic AI. It's going to happen. It is happening. It's not a prediction. It's happening as we talk. And the orchestration layer, and as Ward puts it, sophisticated next generation enterprise software suites, that's where the money's going to go, the disruptive stacks. So anyway, yes, I personally think Railtown will hit high prices. I think it's an asymmetric bet. I think Railtown it's very hard to believe, but if Railtown just gets a sliver of the annual spending data centers, enterprise spending, it could be doing $1, $2, $3 billion a year in revenue. And then you're talking about a company that has rail high prices. And the thing is to try to make sure that we manage our accounts well, as Ward pointed out. If this goes to $550 a share in, let's say, 3 years, I mean, it's possible. We got 1 trillion smackers. 1 trillion smackers is a lot of smackers. Unknown Stuntsman. Hello, hi, Uncle Bill. Hi. G. Diddy. Hey, G. Diddy is here. Good afternoon, all. Please put me down. That's great. G. Diddy. There's a handful of you guys that just have really impressive positions. It's more than a handful. I'd say it's 1 or 2 dozen of you. And I think anything over 50,000, anything over 20, 25,000, heck, anything over 10,000 is a big position. And even the smaller positions are going to be meaningful. It's pretty exciting. I don't know when this trade deadline ends. I guess 6 o'clock or 5 o'clock. White Sox acquire Jody Bart. All right, let's keep going. John, that's great, G. Diddy. Another 10,000. I'm going to put it down. And that probably gets us, that definitely gets us above 23,724,000. It gets us to 734,000. So we're getting closer to 750,000 to tag on to our 23 million. Gandalf, I'm not going to give a long leash. I really am not. I don't have the heart for it anymore. But let's see what you're saying. Form 7 for June is still not published. July deadline ends in a couple of days. Thoughts? Well, what I understand, and I can't confirm it because I couldn't find it in writing, but what I understand is because Railtown now qualifies, let me put it simply, I might be wrong, but Railtown was on a watch because it got upgraded to the, I don't know from what, to the Canadian Stock Exchange, the CSE. But it had no revenue. It was pre-revenue and it was R&D. And so during that period, it had to make its updates. It was very closely monitored every month. But I think because Railtown has now moved into no longer being an R&D company and is actively commercializing and bringing in revenue, I think it's in a different category. So I think they escaped the watch. They're off the watch. I think that's one explanation. The other explanation is that Canada, the CSE, is just removing that whole requirement altogether. And I think that could be another explanation. But it all boils down to, I don't think Railtown has to file anymore. And I think it's a very good sign. I believe you're going to find out here in the next 3 weeks or sooner, you're going to find out that Railtown is producing revenue. And that's a different category. It's no longer on the watch list. That's my opinion of what's going on. I think it's a good sign. You may be trying, maybe, I don't know, but you may be trying to spin that as a negative. I think it's a completely positive sign that Railtown doesn't have to, which is my understanding. I haven't seen it in writing, but I've heard it, that Railtown no longer has to make that Form 7 filing. And I wouldn't be surprised before too long if Railtown were uplisted, let's say by the end of the year or the beginning of next year. I hope it's not to the NASDAQ, but maybe the New York and maybe the Toronto Exchange. And then, those filings become moot. I don't think it's the issue anymore. When you have a company that's trying to make it and trying to get there, I think that's when you're on the watch. When you've turned the corner, you have all the money you need. My opinion, based on information and belief and reading the tea leaves, the company's producing revenue, and we're about to find out. It won't be much. It won't be much for the second quarter. But I think the third quarter could really surprise people. So those are my comments. I don't think it's a matter of not published, and I don't think there is a July deadline. I just don't think they have to do it anymore. They're no longer on the watch, whatever watch it was. John Ken, I added 400. All right, John Ken. That's great. If 400 goes to $25, I better check before I say it. I'm so bad. I used to be able to do it all in my head, but yeah, I was right. It's $10,000. Oh shoot. They signed me out on the stock prices, but we don't need to worry about that. Ward Richardson, your 23-cent shares will be worth hundreds of dollars per share, not in 10 years, but just in a few years from now. And I would say within a few years. Things go pretty lickety splitting when it happens. And I agree with Ward. Ward's done a lot of analysis of it. But it's not going to be straight up. And we've already experienced about as much of the risk that I want to experience. But this was the risk, that we had to give it time and the system would grind the share price down. But many of you are in the position that you've built these enormous positions, and I congratulate each and every one of you. We're very close to 24 million shares. So it's astonishing. Pat M. Ward, I love how you think. I love the cut of your jib. Ward Richardson, Pat M. Rail Town Strong. All right, let's see if I can find where I left off. I want us to have an understanding of what happens in the world of small cap financing. And I just ran out of energy yesterday to finish. Now, what this is going to be the girl again. She's great. This is Gemini. And I signed in, as opposed to what I first read to you. I hadn't signed in. So we'll see what the answer is and see if there really was much difference. But it is different, and there's more to learn. So, see, I asked the same question up above. Can you give me a primer on all the same question that I asked before? So the answer came back. It is entirely understandable to feel like the microcap and sub $5 stock market is a rigged game. Yes, it's very easy to feel that way because the structural mechanics of this environment are brutally unforgiving to retail shareholders and the underlying companies alike. What you are observing is not necessarily a shadow conspiracy, but rather, and this is fair enough, the cold, hyper-efficient evolution of modern market plumbing, regulatory frameworks, and capital raising. Here's a breakdown of how the microcap ecosystem actually operates, where the old market went, and why these stocks often feel like they trade in a completely different reality. One, the disappearance of the old market. Decades ago, which I remember, scary, the market was driven by human specialists, robust retail brokerages, and dedicated small cap research desks. Today, that ecosystem is largely gone because of a few massive structural shifts. For example, decimalization came in 2001 when stocks moved from trading in fractions, like an eighth of a dollar, to decimals, which is pennies. The spread, it was 12.5 cents at an eighth. Obviously, a decimal is pennies. The spread, the profit margin for market makers, collapsed. Human specialists and regional brokerages could no longer afford to provide deep research or physically work a small cap order because the profit incentive evaporated. So a firm like, it happened at Merrill all the time, but other firms too, at the end of the day, attention all, we were called AEs back then, attention all AEs, attention. This is Vinny from the block desk. We have 150,000 shares of, pick one, Exxon available, or picking over a NASDAQ company, 150,000 shares of maybe Apple at $25, and we can offer 3/4 of a point. And if the stock closed at 26 or 25.5, a lot of people could get on the phone to their clients, and they wouldn't, when they offer 3/4, it would show up to the broker or to the wealth advisor on their production run but it wouldn't show in the price to the client. And I can't make it up the way it used to be, but that's an example, maybe imperfect, because that's the New York Stock Exchange. That's the NASDAQ stock if it were Apple. But anyway, that's all gone now. You no longer work those orders. You could have uh, one of the stocks I built a position in when I was at Merrill was a company called Verifone. And every now and then somebody would have a big block they wanted Merrill to work out of, and it would come across to us and there'd be a special on it. That doesn't happen anymore. It just doesn't happen. There's no human beings anymore. So now what's the other reason the old market disappeared? The rise of passive investing. Trillions of dollars moved from active stock picking into index funds. Trillions of dollars. You know, you go in to get advice and you might as well be walking into a showroom of insurance agents. Why don't you just put your money here in this index fund? And so these institutions largely ignore microcaps. How do they define a microcap? Any company under $250 million to $500 million in enterprise value or market cap. Because the position sizes they would need to take to make a difference in these institutional returns well, I was going to read it the other way around, would need to be too big. But in these smaller cap companies, the positions would be too small to move the needle for the funds. But it's large enough to accidentally buy the whole company because it's all done by computer. You've got trillions of dollars and you can't allocate it to a $500 million company. Just can't do it. And now research is expensive. Without wide spreads or massive trading commissions, Wall Street firms stopped paying analysts to cover microcaps. And there were a lot of good analysts out there. Today, much of the research, quote unquote, you see is pay to play, which I don't blame companies for that, where the company itself pays a boutique firm to write a favorable report. Or I would argue maybe the boutique firm wouldn't write a report on it unless they liked the company. But it's hard to separate it from the payment. So market makers, HFT and PFOF, when you ask what bona fide market makers really are and why high frequency trading algorithms bother with stocks that trade by appointment, bona fide market makers versus HFT. A true market maker's legal obligation is to provide a two-sided, quote, a bid and an ask, to maintain a fair and orderly market. In the past, human specialists would step in with their own capital to buy when everyone was selling, smoothing out volatility. Today, market making is entirely algorithmic. Their goal is not to support the stock price. Their goal is not to support the stock price. Their goal is to capture the spread, buying it at $1 and selling it at $1. Thousands of times in a second, while holding as little inventory as possible overnight. Of course, they do it in dark pools so you don't see it. Why HFTs target microcaps? High frequency traders love volatility. Even a stock, even if a stock has low volume normally, the moment news hits, algorithms swarm it. They're like those um, those weird looking crab octopus machines that swarmed the ships in the Matrix. Algorithms swarm it if there's news. They aren't investing in the company. They're trading the momentum of the order flow. So when you see the selling, it's likewise. It's not about the fundamentals. They haven't read the news. So the Citadel payment for order flow dynamic, firms like Citadel Securities pay retail brokers like Robinhood or Schwab for the right to execute retail trades, a practice called payment for order flow, PFOF. This isn't technically front running, which is illegal, but well, I bet if you looked closely enough. But they call it rather internalization. See how the lawyers are clever, the attorneys? So they internalize the front running, and therefore it's allowed. Therefore it's allowed. High frequency trading firms know that retail trades are generally uninformed. In other words, not driven by massive institutional insider knowledge. Institutions do the hard work of due diligence and sometimes have inside track to knowledge. They can't trade on material non-public information, but it happens. But they have confidence in their models and their information. So the high frequency trading firms know that schlubs like us, the retail traders, we don't really have that access. So for an HFT, it is highly profitable for them to trade against retail's flow of orders, offering retail a fraction of a penny better than the public exchange price, while pocketing the rest of the spread. And to idiots in Congress, hey, you're giving them a better price. I wish someone would man up or woman up and change it, but no one does. So this is toxic financing death spiral. This is perhaps the most destructive force in the micro cap space, the death spiral, toxic financing. When traditional banks and institutions will not lend to a struggling cash microcap, the company is forced to turn to toxic or predatory lenders. I don't think it should be allowed. How do you make money investing in falling stocks? In other words, how do these Eastons and Kramers and Rubensteins make money in quote investing in falling stocks? Well, I can't read all that. They call it penny corp. But if the stock is trading at 5 cents up here and you lend money in a death spiral, the death company must wait months to convert. The share prices drops to 3 cents and lower, but the conversion is into those lower prices at a discount. So the lender's profits over here, actually they book, in this example, 100K, and the stock price goes from 5 cents down to 0.000000005 cents. What this analysis leaves out, and no one allows for, is that the groups like the Anson funds and the Toad are actively shorting illegally, spoofing and all that illegally, the stock. And they take 100 million, 500 million. There's a guy down in Puerto Rico who actually invested in Finger, and he made his $400 million fortune doing this shorting. And, you know, I think the problem is it's just enough of parts of it are legal. And it's just complicated enough that no attorney wants to go over it. So, I don't know. I wish they'd change the rules. All right, so let's keep going. Here is how a floorless convertible note, a death spiral, and an at-the-money ATM facility strip retail shareholders of their capital. A lender gives the company $1 million in exchange for convertible debt. The catch, the debt converts into stock not at a fixed price, but at a floating discount, 30% below the trading price. Yeah, good luck. The spiral, the lender converts a small chunk of debt into shares at a discount and immediately dumps them on the open market. In practice, this is what the attorneys want you to believe is happening. In practice, the selling is happening before the note is even signed, before the conversion. They already have their cash, but it's all hidden. It's all opaque. No one wants to call it. So the selling pressure drives the stock price down. The kill, because the stock price is now lower, the next time the lender converts the debt, they get even more shares for the same dollar amount. They dump those, driving the price down further. The mathematical loop continues until the stock price approaches zero, diluting retail shareholders to dust. And you know what happens? There's no 1099. The stock is essentially zero, but there's no closing transaction. There's no risk to the prime broker or to the hedge funds doing this in the background. They take their money out, particularly if there's a reverse split. They get to take a huge amount of money out, and they don't have to pay taxes on their profits. Diluting retail shareholders to dust. Why is this legal? Here it is. Because of disclosure. The SEC's primary mandate is not to prevent you from making a bad investment. It's just to ensure you that you were warned. I would argue they don't do enough of it. Attorneys draft these financing agreements and file the financing agreements in 10Qs and 8Ks. If the terms of the toxic debt are fully disclosed in SEC filings, the regulators treat it as caveat emptor. Buyer beware. The regulatory void and NASDAQ's role, the SEC and the OTC. The SEC hasn't completely abandoned the OTC, so that's not evident. But their approach is highly automated In 2021, they amended Rule 15C-211, which forced OTC companies to maintain current public financial information. If a company failed to do so, brokers were banned from quoting them, moving thousands of dark companies to the expert market. The expert market you should never play in, ever, where retail cannot easily trade them. However, policing individual manipulative toxic financing requires resources the SEC simply doesn't dedicate to the sub $5 space unless there is outright provable fraud. Is NASDAQ still a jewel? NASDAQ is a for-profit business. They should change that, in my judgment. They make money on listing fees and data feeds. While they have minimum bid price requirements, that's the famous $1 rule, bid, and equity requirements, many microcaps use reverse splits in order to artificially maintain their NASDAQ listing. The exchange provides prestige, really, but listing on the NASDAQ does not inherently protect a company from toxic debt or from predatory algorithms, or both. Why good news gets crushed. You noted that press releases are met with a rush of buying, only for the stock to be ruthlessly sold off. This is a mechanical trap. The algorithms read news feeds in milliseconds. They buy the spike instantly, riding the initial surge. The ATM lenders, the company itself, using an ATM facility, or the toxic debt holders have been waiting for liquidity. They cannot sell 5 million shares on a random Tuesday because there are no buyers. But when a good press release, quote unquote, drops, retail rushes in to buy. The company and the lenders use this artificial retail demand as exit liquidity, depending on the financing, dumping millions of shares into the buying pressure. The result, the algorithms sell out of their positions in minutes. The lenders dump their shares, and retail is left holding the bag as the price collapses below where it started. And I'll leave it to you to kind of suss, why do people come here promotionally? The Frank Benedettos, the Dan Borders, and even some guys on Discord who talk about AME and GMC. And you could ask me, when I look at it, our efforts have helped keep Railtown up for this churning. But all I can tell you, that's not what I'm doing. But the fact is, whether it's good intent or bad intent, the process of talking about these companies does help these machines. If, for example, my judgment is wrong, I don't think it is, and Railtown ends up taking, for example, a toxic financing, I don't think that's going to happen at all. I think Railtown is fully funded and runs a lean, mean machine. and is about to have revenues literally explode upward. And you're about to see it. But just remember when people are pitching a stock to you and they're getting all excited and they're telling you it's going to go to 3,000, they may not know what they're doing. Or in the case of a guy like me, I'm not doing it on purpose. But on the other hand, I want you to own Railtown. I think we're going to get huge benefits from owning it. It's just the nature of the beast. That's all. But I would argue some people are speaking their own book and they flip out of the shares into your buying. Look, it's just the market. There's no perfect, you're not going to find a perfect situation. So we have to judge it, be agile, and you can still make money, as I think you're about to find out. For example, in Railtown, make a lot of money. How can a company escape the hell? You are entirely correct. Sustained fundamental institutional buying is the only way out. Sustained fundamental institutional buying is the only way out. And by the way, we've done that in Railtown. We've started to do that in Total Metals. And we might pick another couple of stocks too. My job in August, because I got to keep you distracted, I'm going to work. Maybe I'll get some interviews, and that would be the way we do it. Algorithms and toxic lenders thrive on low liquidity, cash-strapped environments. To break the cycle, a company must permanently change its financial reality so that real institutions, mutual funds, pension funds, standard hedge funds, are forced to care. Really, Bill, I do care. I'm meant to come into a bit of money. This requires undeniable cash-generating milestones. This requires undeniable cash-generating milestones which render toxic financing obsolete. So if you get massive, verifiable revenue, not letters of intent, not partnerships, but instead audited, bottom line cash flow that allows the company to fund its own operations without returning to the at-the-market nightmare. Or if you get definitive regulatory approvals, for example, final FDA approval, not phase 1 trials, but final approvals that allow immediate commercialization. Or you get a clean capital structure. The company aggressively pays off or negotiates the retirement of toxic convertible notes, closing the at-the-money nightmare so that a rising stock price isn't immediately diluted. And this can happen. Honest shareholders cannot buy their way out of a death spiral. The arithmetic of floating convertible debt will outpace any retail buying power, any retail buying power. The only defense is strict due diligence, reading the 10Q, identifying the terms of the convertible notes and warrants, and refusing to provide exit liquidity to companies trapped in predatory financing loops. And once they are, there's just no way out. So explain the exact mechanics of how reverse stock splits are used by microcap companies and how they benefit toxic lenders and short sellers. The answer comes, a reverse stock split is a corporate action in which a company reduces the total number of its outstanding shares by consolidating them into fewer higher price shares. For example, in a 1-for-10 reverse split, every 10 shares an investor owns becomes 1 share, and the stock price theoretically increases by a factor of 10. And also any margin requirement like $2.50 a share, it gets reduced from 10 shares to 1 share. The total market value of the company remains unchanged, obviously. While seasoned companies rarely use these splits, reverse splits are common among microcaps and OTC companies. They are a critical tool used to maintain exchange compliance, but they also serve as a mechanism that can benefit toxic lenders and short sellers at the expense of retail shareholders. The purpose of a reverse split. The primary reason a struggling microcaps company executes a reverse split is survival, specifically to maintain a listing on a major exchange like the NASDAQ or the New York. One example is the $1 minimum bid requirement. Both the NASDAQ and the New York require listed companies to maintain a minimum bid price of $1 a share. If a stock closes below $1 for 30 consecutive business days, the company receives a deficiency notice and has 180 days to regain compliance, with the possibility of extensions, although that seems to be going away on the NASDAQ. The quick fix, the plural of that, the quick fix, a company trading at 20 cents can execute a 1-for-10 reverse split to instantaneously push its share price to $2. This is a temporary cure of the minimum bid deficiency. Exchanges have recently tightened rules around this practice. For instance, NASDAQ will automatically suspend and move a stock to the over-the-counter market if it fails to regain compliance after a second 180-day grace period. And companies are generally ineligible for compliance periods if they have effected a reverse split in the prior year. How it fuels the death spiral. A reverse split does not fix the underlying financial problems of a struggling company. If a company is burning cash and relying on toxic convertible debt, the death spiral financing discussed previously, a reverse split acts as a reset button that allows the dilution to continue. Here is how the mechanics benefit predatory lenders. 1, the floor is reached. Toxic debt converts to shares at a discount to the current market price. Eventually, the stock price drops so low, for example, 5 cents, that the lender has effectively maxed out the number of shares they can extract, or the company runs out of authorized shares to issue. So the reset. The company executes a reverse split, 1 for 50. The stock price jumps from 5 cents to $2.50. The total number of outstanding shares is drastically reduced. 3, the dilution resumes. The toxic lender now has a fresh, higher stock price to short against and convert debt into. Because the share count was reduced, the company has freed up room under its authorized share limit to issue millions of new shares to the lender. And then 4, the cycle repeats. The lender converts debt at a discount to the new $250 price, dumps the shares on the open market, and drives the price back down to zero. Now, I argue that in the shadows, a lot of selling of stock that doesn't exist goes, adds to this. Oh, that's not what I want. That is not what I want. That was advice on what I'm trying to do with our gold company and setting up a company for all of us to participate in the future. In the future. It's odd that it had the same numbers. It's 100. Which as I do it, I'm committed to work on it over August. I'm going to try to work hard in August so we're ready in September, October to take advantage of what could be fast-moving markets. All right, so here is where I want it to be. A multi-year stock chart that shows a current price of $250, but historical prices in the thousands of dollars. Have you seen any of those? Is a glaring red flag that a company is trapped in this cycle of toxic dilution and reverse splits. And that's why I finally blocked Tolstoy King, because he's trying to get you buying into these stocks that have historical highs, 1-year highs of thousands of dollars a share, like COSM, 5-year highs, and get in because it's on his radar. My opinion, he's just trying to get you to provide liquidity so the high frequency trading guys can come in and take advantage of your dollars, and then he gets a kickback. And he might just be doing it because he's got a short position, but I think he gets a kickback. And I finally had enough of it. I could be wrong, but c'est la vie. How short sellers profit. Short sellers who profit when a stock price falls also benefit heavily from this environment. The infinite short. When a toxic lender converts debt and immediately sells those shares, it creates massive downward pressure. A sophisticated short seller, or the toxic lender themselves, hedging their position, can confidently short the stock knowing that the structural mechanics of the convertible debt guarantee a relentless supply of new shares hitting the market. So the post-split selling, historically, struggling microcaps that reverse split see their stock prices decline shortly after the split. Short sellers view a reverse split not as a sign of recovery, but as a technical maneuver by a fundamentally weak company that is out of options. They will often initiate or add to short positions immediately after the split takes effect. Retail shareholders are caught in the crossfire, suffering near total loss of capital as their share count is repeatedly decimated by reverse splits and the share price is crushed by continuous dilution. And I want you guys more than anything to just recognize this. Now, it doesn't mean every stock that takes financing or every stock that has an idea or every stock that's, rolling the rock up the hill like Sisyphus is going to have it roll back down the hill on them. But, when people come and tell you that a reverse split is good, for example, they're either not telling the truth or someone didn't tell them the truth. What is the truth exactly? I had a witness at a trial once, and the judge asked him a key question in the case, and that was his answer. And what is the truth exactly? What does it mean? All right, can you explain the mechanics of how short sellers borrow shares to short a stock, especially when a stock is hard to borrow or heavily shorted? To understand how short sellers operate, especially in the treacherous waters of microcap stocks, you have to look at the plumbing of the stock market, specifically the securities lending market. At its core, short selling requires a trader to sell something they do not own. To do that legally, they must borrow it first. And that doesn't happen, by the way. That doesn't happen. Not intraday. Everyone assumes that all these people are gentlemen. Trust but verify, I say. I say trust but verify. That's what I say. All right, okay, so here's how it works. The short selling process. The broker, anyway, this is the process. This is how it used to be before they all do it illegally and they re-hypothecate. I'm not going to go through it because it's a waste of your brain cells. I am going to go find the slide that's missing. I think I just deleted it. There's so many trades going on. Okay. Where do the shares come from? When a retail trader or a hedge fund click sell short on their terminal, their broker must locate shares to lend them. These shares come from three primary sources. Margin accounts. If you as a retail investor have a margin account, you almost always do. A margin account is a type 2 account, and they almost always make you sign it as you don't even know you're doing it. With your broker, there is a clause in your user agreement that allows the broker to lend your shares to short sellers. You still see the shares in your account, and you can sell them whenever you want, but behind the scenes, they've been lent out. Institutional lenders, these are the ETFs. That's why I think when ETFs get into crypto, for example, rut-row, massive index funds, pension funds, and ETF providers like Vanguard or BlackRock hold billions of shares. They lend these shares out to short sellers to generate extra yield for their funds. There you go. The broker's own inventory. The broker dealer may hold a physical, they do hold a physical inventory of the stock and lend it directly to the short seller. And they can rehypothecate. They can how's that song go? Respect. The hard to borrow reality, the HTB. In large caps like Apple or Microsoft, borrowing shares is nearly free because there are billions of them sitting in passive index funds. However, in microcap stocks, especially those undergoing death spirals or reverse splits, shares are often scarce. This triggers the hard to borrow designation. When a stock is HTB, the mechanics change drastically. The locate requirement. Under SEC regs show, a broker must have, quote, reasonable. What the heck is that? Reasonable grounds. You get an attorney, reasonable grounds. What the heck? To believe they can borrow the security before executing a short sale. Reasonable grounds. Unbelievable. This is called getting a locate. You guys, if you don't see it, you don't see it. Borrow fees, supply and demand takeover. If the stock is heavily shorted and shares are scarce, the broker charges a daily borrow fee. That gets expensive. For standard stock, this fee is less than 1% annualized. For HTB microcaps, borrow fees can skyrocket to 100%, 300%, or even 1,000% annualized. The arithmetic or math, I guess, when you get into those percentages of HTB, if a hedge fund shorts a microcap stock with a 300% borrow fee, they are racing the clock. The stock must drop dramatically and quickly, or the daily interest payments will wipe out their capital. How toxic lenders bypass the borrow problem. You might wonder. I don't wonder. I wonder why you don't see it. If microcaps are so hard to borrow, how are they relentlessly shorted into the ground during a death spiral? The answer lies in the toxic financing agreements, the convertible notes we discussed earlier. And I think there's outright lying and fraud going on too. But anyway, it's enough. Just the note is enough. When a predatory lender holds a toxic convertible note, they essentially have a contractual guarantee that they can convert debt into new shares at any time. Why anybody signs these things? Because they have this legal right to new shares, prime brokers will often grant them to them a locate based on the convertible debt. The lender doesn't need to borrow shares from a retail investor. They are shorting against the inevitable flood of new shares they are about to create. Technically, you're not allowed to short when the shares are going to be delivered in 6 months. But hey, it's reasonable. We're all friends. Let's be reasonable here. Naked shorting and fails to deliver. When the system breaks down, you get naked shorting. Yes, you do. Naked shorting occurs when a trader sells a stock without having borrowed the shares or without ensuring they can be borrowed. While the SEC tightened rules against this after the 2008 financial crisis, loopholes remain, and how? Particularly for bona fide market makers. There is no such thing. The market maker exemption to maintain liquidity because you all know you need it so badly. All of you just freeze, you never sell the stock. To maintain liquidity, market makers are legally allowed to short a stock without a locate under the assumption that they will find the shares shortly after to settle the trade. Unbelievable. This is your SEC under George W. And then under Obama. Fails to deliver FTDs if the market maker or short seller cannot find the shares to deliver to the buyer by the settlement date. It results in a fail to deliver. The micro cap trap. In heavily manipulated micro caps, FTDs can pile up massively. If millions of shares are sold short but never actually delivered, it artificially inflates the supply of the stock, crushing the price. While the SEC publishes FTD data, enforcement and forced buy-ins on the over-the-counter and microcap level are notoriously slow, would you believe never, and difficult for retail to track in real time. If short sellers are trapped paying massive borrow fees, how exactly does the short squeeze trigger? And what are the mechanics behind one? A short squeeze is one of the most violent mechanical events in the stock market. It happens when a heavily shorted stock rapidly rises in price, forcing short sellers to buy shares to cover their positions, which in turn drives the price even higher. When short sellers are already bleeding capital because of massive hard-to-borrow fees, they are holding a ticking time bomb. They need the stock to drop quickly. If it goes up instead, the mechanics of leverage turns against them. Here is the anatomy. 1, the powder keg, high short interest and high fees. For a true squeeze to occur, the conditions must be primed. A large percentage of the stock's tradable shares, the float, is sold short. Because The world is round. Because the stock is scarce, borrow fees are exorbitant. 100 or 300% annualized, for example. The short sellers are trapped in a staring contest. They are paying massive daily interest and waiting for the company to collapse so they can cash out. The squeeze begins with an event that brings a sudden wave of legitimate buying volume. This could be a massive earnings beat, an unexpected FDA approval, or a buyout rumor, or a coordinated retail buying campaign. This influx of buy orders starts pushing the stock price up, moving the trade against the short sellers. The margin call, the ignition. When you buy a stock, the most you can lose is your initial investment. When you short a stock, your potential losses are mathematically infinite. To protect themselves, brokers require short sellers to maintain a minimum amount of capital in their accounts, which gets vastly reduced when there's a reverse split, by the way, known as maintenance margin or the maintenance requirement. As the stock price rises, the short sellers' unrealized losses grow and their required margin increases. If their account value falls below the broker's threshold, if their account value falls below the broker's threshold, they receive a margin call demanding immediately that they deposit more cash. And then there's forced liquidation. If a short seller cannot or will not deposit more cash to meet the margin call, the broker steps in to protect its own firm from risks. The broker forcibly liquidates the short seller's position. So there's market buying. The broker does not care about getting a good price. They care about closing the risk. They issue market buy orders to purchase the necessary shares and close the short position immediately. The feedback loop. These forced buy orders hit the open market, driving the stock price even higher. This new higher price triggers margin calls for the next tier of short sellers, forcing their brokers to buy. This creates a mechanical cascading loop of forced buying that entirely detaches the stock price from the company's actual valuation. 5, the share recall, the accelerant. There is a second equally dangerous trigger for short sellers, the share recall. The institution or broker that originally lent the shares always retains the right to demand their shares back. If a stock becomes wildly volatile, or if the lender simply decides they want to sell their own shares on the open market, they issue a recall. The short seller has no choice. They must go into the market, buy the shares at the current inflated price, and return them back to the lender. If multiple lenders issue recalls simultaneously during a price spike, it acts as pouring gasoline on the fire. Can you explain how short sellers borrow shares to short a stock? I thought we just went through that. What a stupid question I asked. To understand how short sellers operate, especially in the treacherous waters of microcap stocks, you have to look at the plumbing of the stock market, specifically the securities lending market. At its core, short selling requires a trader to sell something. To do that legally, they must borrow it first. I don't know. I feel like we already answered that. So I won't bore you if I asked it again. But let's just see what I did. Let's just see what I did. Because the world is. Love is old, love is new. Love is old, love is. Right, so we'll move on. I think you already know the answer on legal shorting. So even though courts do not see it and no one can prove it, is it possible that people with avarice on their minds collude to take candy from babies in these markets? Yes, it is absolutely possible. In fact, the structural reality of the microcap and sub $5 markets makes it a daily occurrence. The frustration you were describing, the feeling that the market is a machine designed to extract wealth from retail investors while regulators look the other way, is grounded in how these markets actually function. You don't necessarily need an illegal coordinated conspiracy in a smoky back room to achieve this. You just need a system where the incentives of the most powerful players naturally aligned against the least informed. The taking candy from babies analogy is chillingly accurate, even when courts cannot prove explicit collusion. Implicit versus explicit collusion. The legal system requires hard proof of explicit collusion, emails, wiretaps, or whistleblowers showing that a hedge fund A agreed with toxic lender B to crush a stock. Because these players are highly sophisticated and backed by elite compliance departments, they rarely leave that kind of paper trail. However, the market operates, and this is my contention, on implicit collusion, nods and winks, also known as structural alignment. A toxic lender, a prime broker, a short seller, and an HFT firm do not need to text each other to destroy a microcap stock. They simply execute their independent, highly optimized strategies, and they communicate with each other. They can tell from each other's orders who they are, often. So the lender converts debt into shares at a massive discount to dump those shares on the market. The prime broker happily collects 200% interest lending those shares or phantom shares to short sellers. The short seller attacks the bid, knowing the lender is diluting the company. The HFT algorithm front runs the panic, making a fraction of a penny on every panicked retail sell order. None of these parties had to speak to one another. They simply acted on their own greed within a regulatory framework that permits these mechanics. The result is indistinguishable from a coordinated attack. I don't know why it's allowed. The weaponization of complexity. Retail investors are the babies in this scenario, not because they're unintelligent, but because they are structurally outmatched. They are outmatched. And how often do I preach to you? You can't win against some of this. The market uses complexity and information asymmetry as weapons. For example, legal engineering. When a company signs a toxic financing deal, the terms are buried in 100-page SEC filings, like an S1 or an 8K. And they're written in dense legalese. Retail investors generally read the optimistic press release about a new product or a new partnership. By the time retail buys the stock on the quote unquote good news, the algorithms have already parsed the 8K, identified the tox. Do you see it's done by computer? Parsed the 8K, identified the toxic dilution, and they begin shorting it. I believe they short it whether or not they own the shares, located the shares, smoked the shares, rolled the shares up, diced the shares, planted the shares, grew the shares, washed the shares, laundered the shares, whatever. They just start selling. The speed asymmetry. Retail investors are looking at quotes. Listen to this. Retail investors are looking at quotes that are milliseconds old on their phones. High frequency trading firms pay millions of dollars to place their servers physically. Can you say Ken Griffin? Next to the exchange's servers so they can see order flow and react to it in microseconds. It's a drone fighting a person who has a stick. And they call it internalization of order flow. They don't call it front running. We're all reasonable men here, and they're all men. We're all reasonable. We're gentlemen. You get the attorneys to cover it up and lie for you. When unprovable becomes a fact, history shows us that when what courts and regulators dismiss as unprovable paranoia often turns out to be entirely real once the veil is pierced. For years, retail traders complained about spoofing, for example, where massive algorithms would place huge fake sell orders to terrify retail into selling. And I also think in its communication, only to cancel the orders at the last millisecond and buy the shares on the cheap. For a long time, it was impossible to prove, and regulators ignored it. Of course they would. Eventually, the Department of Justice caught on, and major financial institutions paid billions, a pittance to what they make, paid billions in fines for doing exactly what retail's traders had said they were doing all along. The absence of proof in court of law, the absence of proof in a court of law does not mean the absence of exploitation. Trading is often a zero-sum game. For predatory financing firms to make 10 million in a microcap stock, someone else has to lose 10 million. Without institutional buyers in these low-tier markets, the only people left to fund those profits are grassroots retail shareholders. All right, so let's go to your questions. And the trading stopped. I guess the deadline ended. Let me go to your comments and questions. I'll try to, I might take a break just to get some energy. I'll try to finish today what I wanted to finish yesterday and maybe get into new subjects. But today I had to work on, paperwork and things. And I fell behind on preparing here. So let me go with your comments. Pat M, let's start with Pat M again. Ward, I love how you think. Ward Richardson says 10,000 shares. If you own 10,000 shares and you're able to hold on to it, Ward believes that Railtown can go to 500. I've heard him tell me much higher numbers, but it equals 5 millions, and that's no joke. Rail engine, 10,000 shares, that's all you need. Now, I'm not saying diamond hands. We're gonna watch, and we're gonna continue to be what we've become, a well-researched, deep diving due diligence. For now, we're a small, sort of bespoke ragtag institutional, microcap institutional investment firm. That's what we are. Harbison, quote, all firms must answer for rogue bots, says boss of hacked company, Hugging Face. Yeah, we went through that before. I'm trying to remember the details. I think they went after Anthropic, or no, they went after OpenAI. Can't remember, but we went through it. Quote, bot makers must be accountable for cyber attacks carried out by their creations. So that Harbison is bringing up something about Railtown beyond governance, beyond, although it's part of this, beyond keeping the agents on the track, so to speak, beyond metering, beyond design, beyond even observance, although it's part of that. It's accountability. It's being able to have a record to show a third party what happened. That's very powerful. Very powerful. Ward Richardson, has anyone actually here or heard? It's a question, so I'll say it. Tony, speak to Corey, or Corey answer back to Tony. That's a question from Ward Richardson. Harbison, quote, everyone has to remember that a cyber attack is a crime and it's illegal. Hugging Face had to rebuild around a third of its IT network after the unprecedented attack. Harbison, DeLange said he hoped legal frameworks would ensure the companies that make mistakes leading to hacks are, quote unquote, accountable. Roadhouse, I love it. Roadhouse. Yeah, I mean, Rail Town. Rail Town. Exactly. You got it, Harbison. Harbison. Claude also admitted that its bot had attacked 3 companies in similar circumstances in recent months. So it was Anthropic. It was Anthropic. This is a huge thing, Harbison. When Railtown goes out to talk to the 98% of the enterprise market in Canada, of which only 6% has turned to AI, the 3 things they got to answer, and we can add to the list, but it's cost, it's safety or security, it's redundancy, and I think this issue that you mentioned falls into maybe a 4th category of being comfortable with Microsoft, Amazon, Google, and why are we going to switch? It's very important, and that's why the orchestration layer is going to be huge, because companies like Hugging Face and Anthropic, if clients are not going to move, you've got trillions of dollars that are going to go poof. So it makes and I'm saying orchestration. I want to be clear. Railtown doesn't own the whole orchestration layer, nor are they the entirety of the market, but it's a gigantic market. And the name of this layer keeps changing. That's how quickly the space is evolving. Is Pluto a planet? If it is, you're from it. No, I'm just kidding. I was thinking that Railtown has opportunity to have an offshoot that caters to those who need AI accessibility because of poor vision. Call it Brailletown. Well, that's clever. I suppose you could call it Charlestown if you want to get into that kind of humor. I personally am uncomfortable making humor about people that have such things to deal with. Ward Richardson. Yeah, I see no one answered my last post. I kind of figured out that no one physically heard these 2 men speak to each other. It certainly does not surprise me. I think it occurred, but I don't know. What's interesting, if I'm right, and I don't want to get into it because that one gentleman, and I'm trying to remember his name, but he said it would be best, that the guy you're referring to has good perspective. I have a different one. I don't know. I think it's really risky listening to him, because I think his objective is to keep people's money hot. My objective is to start treating our allocations of capital as if we are a sensible institution doing our research, placing, there's no perfect bet. There's no investment without risk. We've just experienced it in Railtown. And I mean, I've been completely wrong. I didn't make them up. But in my deadlines or my targets, I've been completely wrong. But I think we paid that price, and I think that's behind us in September. I think August, which is why I'm going to work hard. I'm going to distract you. We're going to talk about other things. We're going to have ideas in our head. We're going to talk about Railtown all along, and Railtown can go up. My opinion, from what I'm seeing in the market, they are trying to get the stock downward. Of course, that's what they do. But I think there's buying. I think the algorithms are seeing a buyer. That's what I think. But Ward might have a good point. And I certainly respect Ward's judgment. T. Alex. Anyway, I was going to say, Ward, if he did actually, it's weird that he comes away from those conversations with negative feedback. But I guess that makes him sound like he's helping. You know, it always sounds helpful to give warnings and negative views. That sounds like you're being a friend. Beware of that, because that's part of the psychology that these people are trained on. I'm not saying he's one of them, but that's what your enemies are trained on. T. Alex, no one has heard them or the so-called interview. Again, I'm not saying the name myself. T. Alex says Tony comes across as, quote, a snake in the grass. Maybe he talked to his buddy once to find out about his well-being. I am the viper. T. Alex. He has then played up that conversation as if he has a low open line of communication anytime, lots of laughs. The only information he talks about is what he hears from us. Look, but you got to remember, and see, you can turn that around and say I'm doing it. So it's clever. But I admit to you, I get unsatisfactory access right now. I'm not mad about it. I understand it, but I can't call anytime. But if these people can befriend you, when these shares, you know, when your shares, let's call it 24 million shares, go to $10, that's $240 million. Can you imagine the saliva that's going to go into the microphones as Benedetto and Borders and this guy and others just come into this audience as if they're friends? I never went into their audiences, ever. And I was not particularly smart. I didn't go build this audience to some huge number, but I didn't want to encroach. But boys, they'll be here, and they're going to be your friends, and they're going to have the next idea, and they're going to lock down contracts with companies, you know, I would guess on the level of $15 to $20 to $25,000 a month, and then 100,000, 150,000 shares free to trade. These are the kind of numbers that I heard one of those guys who had 3 different IR deals. One was with Vision Air or whatever it was called, Vision Plastic. One was with UNLV or whatever it was. Maybe that was the same one. And one was COSM, all at the same time. They're coming. And that's why T. Alex, that's why I get so adamant. I thought it was best to name where I thought it was so people saw it. But I'm trying to remember. I think it was Eric maybe that suggested that I not uh, pick on him because he's got his own point of view and I have mine. I'm more like Christopher Hitchens. I don't like meeting in the middle if the other guy's wrong. But having said that, I could be wrong. So I I'm trying not to make it something personal, but I do want people to recognize that they're going to come at you and try to shake you out of this stock. And I don't need that. I'm perfectly capable of making rational opinions and judgments and helping you get to where you want to be. I don't need the ad hoc, ad hominem, uh, you know, hackneyed advice coming from the peanut gallery. Um, you don't need it. We have the skills to invest. We have the skills to invest in some of these smaller stocks. And as our portfolios get bigger, if you want to trade some of those, like a stock, you might hear one of these guys with their whiskey and cigarette breath over the phone saying, I got this account and this. Blah, blah. Well, like I've told you, if you learn their patterns, just get in early with a little bit if you want to just do it for fun, because you got to, your other positions you got to hold. I'm not against that when it's a small, tiny 0.5% or 1%, but get in early, let them pump. But no, they're getting out. They're being paid in stock and they sell out into your, and then they come on, well, do your own due diligence. I'm out. I got out. Why didn't you? Guys, it's just a nightmare because they know they can't win unless they just repeatedly take their profits, sell, and if it goes up, it goes up. But 19 times out of 20, the stock ain't going up for very long. So they get out and they move on. So we can learn. You can learn how to do that. But I see a threat to our little institutional hedge fund, such as it is, from these guys or people like them anyway. So let me keep going. Jimbo White, I lived this nightmare in AMC. Yeah, exactly. What I just was reading? Exactly. And I got onto it years ago. Literally, wow. It's almost 30 years ago. I watched an oil and gas company. We were in London. I was in London with my associates, and this company called me up, and the advisors, and they said, can you help us raise some money? I'm not going to say the name of the company because it's the gentleman's name. And I said, well, let me see what we can do. I like it. Short. I had done my research. So we did it. It wasn't a lot of money. It was 300 or 400, maybe 500,000. It wasn't a lot. It was in that range, 500,000. We raised over the weekend. It's mostly my friend making phone calls, but we raised it. And we each were paid I don't think we got cash because the company was short supply of cash. I didn't negotiate the deal. My business partner did. And I think he got, I just don't remember the amount. But I think it worked out that we each received shares that were not, I just can't remember if there was a restriction or if they were free to trade. I think they were free to trade. He drove a hard bargain because these guys needed the money. So I remember I got shares that were worth something like $30,000 for raising, let's say, $500,000. It might have been a little more now that I'm thinking, because that's a nice percentage. But they went to being worth like 60 grand, 80 grand pretty quickly. But then they did a financing, and back then you needed to get the prospectus. You couldn't get it online. And I used to live in DC. I still do now, but I would go to the SEC and I would go into the halls of the SEC records and I would pull the filings. So when this other guy comes to you and says, well, you got to read the filings, I used to go down to the SEC and spend an afternoon there, like I was back at, doing a research report. I did the work. And so anyway, when I got the prospectus through the mail a little late, our office was Hyde Park Gardens, and I can almost remember it, number 2 Hyde Park Gardens, something like that. But it was nice. Anyway, I got it and I read it, and I immediately wrote a letter and called the company. And I told you, I'm not going to bore you right now. I told you the scene where I met him at an oil and gas conference, and I had to stand. He came up to me and he said, "You're the only person that is saying that we," and I told him, I said, "JR, you got to do everything you can do to buy that back. They gave you par value $5 million. It'll cost you $6 million to buy it back. What'd you get? 3.5. You better buy it back, or your company." And it was a 3-generation company. Your company's going to be wiped out. And everyone was against me, and I'm standing there. And I turned to the banker who's made a lot of money, and I said to him, "Mike, you did the deal. Am I wrong?" Because we had a back and forth. I'm saving you that back and forth. And I remember that guy looked down at his shoes. He wasn't wearing socks, looked down at his drink, and he just faded away. He never answered me. And sure enough, my friend, my associate in London, he always sold. And you know what? He was always right. He sold his shares as soon as he could. As soon as they got in his account, he called up, and I think he made 80 grand. He might have made 100 grand on that. Good for him. I didn't sell because I thought it was going to be worth all this money. And I think by the time I sold, if I ever sold, it was a few $1,000s. So that was my mistake all the way back then. Or maybe, I don't remember it. I'd have to check. Maybe I got 10 grand or something, but I didn't. I should have sold right away. But I learned my lesson about these toxic. It wasn't necessarily that the financing would have been called toxic. What I learned, Jim, and I've said it to everybody here over and over and over again, it's not a very sophisticated analysis. But if a buyer, an institution, cannot tell how many shares are going to be out, they do not know the denominator. Of course, they can tell the denominator on one day. But if there's a formula in there, that means the denominator can expand, particularly expand massively. you don't know what the shares are worth, and nobody's going to invest. And that's why I was right then. That's been why I've been correct many times since. I never read the AMC deal, but once it ran up and once it was already up, I never participated. I just told people you got to be careful. And there were 2 or 3 times. One time it ran to $85 or $80. And I remember saying, and Ham was on, I was saying, sell calls. But people got believing, and I'm not picking on anybody. For example, that guy who I think is really hardworking. Right now, I'm having a Joe Biden moment. He's an attorney, and he really follows this subject on AMC and GME very closely. I think he's out of Florida. I met him when he was up here. But you know what? People just, attorneys in particular, they study it and they're shocked. But people just don't have experience in the markets. And you get ripped off enough, you start learning, hey, I don't need all the details. I see those 2 or 3 characteristics, get out, you know? So anyway, that guy lost his company and he became a stockbroker for Merrill Lynch. I'm sure he's doing fine. I'm sure he's doing fine. All right, let's keep going. T. Alex, Jimbo Whitefire. I lived this nightmare in AMC. And then T. Alex is saying Tony is still living it. Well, from what I understand, he still recommends people to get an AMC, and that's one of my red flags. Because what does it do? What have you learned over the last couple of days in this due diligence? And you've probably learned it by experience over the last years, if you think about it. By keeping the liquidity up, and by that means the dollar volume, that gives the machine something to steal. And then your AMC or your GME, these geniuses, they suddenly are sitting on all this cash. Well, where'd they get it from? T. Alex, and I lived the Ham nightmare, everything, and even the death threats. Well, I don't know what to think about Ham looking back on it. I find it hard to believe that Ham didn't understand what was going on, because he saw it. He really saw it in why is my memory? He really saw it in that guy. The guy that ran Nixie, ran Go Logic, ran Logic, Brent's son. For some reason, Ham saw it there, but he never saw it necessarily other places. But I think the thing about Ham is I think he really has been fighting this whole nightmare. And I think he gives advice to people how to trade. I think that's what he's good at. So if you listen to him carefully, if you buy in and sell out and don't fall in love with the positions, I didn't do that. I lost a lot of money, but he does seem to have insight on things that might run. And so he had an investor, a pretty sophisticated woman. I think she's on the West Coast, but she would call him all the time. And she stayed in touch with it and she listened to him. So she would get in early. I think she was originally institutional, but maybe not. And, you know, if the stock went up 2 or 3x or 5x, she got out. And when I look back, why didn't I get out up 5x, 8x? Why didn't I get out? I didn't because I was I don't know. I believed the logic of his short squeeze stories, but I don't believe that anymore. And I don't blame him. I've done a lot of study and I've shared it all with you guys over the last 2 or 3 or 4 years. And I just really think it's very difficult to win. It's very difficult to trade a short story. So I don't know what you mean about the death threats. I believe I got threatened more than once, and I think it included harm. It's big money. It's big money. Ward Richardson, Harbison, regarding your post on cyber attacks, that is where Cincy comes in. They built their software stack as a legal framework foundation. Wow. Ward Richardson, William, we have to get to 500 before we can get to 2,500. I remember. I don't remember the song right now, but I remember the lyric. Come on, y'all. We got to get up before we can get down. We got to get it up before we can get down, or something like that. So Ward is suggesting that Railtown can go to 2,500. I don't know what that would be in terms of market cap. I don't think my computer is going to allow me to see. Well, no, it does. That's almost 600 billion. That's you're starting to talk about a big company. But if you divide that by, let's say 15x, let's say the multiples come down. That means that Railtown would be doing 40 billion a year in revenue. Is it possible? Out of a multi-trillion-dollar annual addressable market? Sure, it's possible, particularly if Railtown becomes the de rigueur interface between users and data centers. It's possible, but let's focus on the I want to see everybody here at least hang on until 25.55. I'm willing to change my perception based on information. And that's what the people that make fun of me, including the guys you just mentioned, miss. When you give a target, it's not like that's the only target. That's what you're basing it on with the information you know. As you get more information, the intelligent, educated investor adapts. Ward Richardson, I have said this before. I see a partnership with Anthropic when companies like Anthropic partner with a company like this. That's why companies like this get into the $1,000 a share. Okay, so let's just state the obvious. One thing that could happen is a company like Anthropic could buy Railtown, and then a lot of the growth happens inside of Anthropic, and we have to get a derivative of that growth. But I happen to agree with Ward here that it doesn't have to be this way, but it's at least possible that the rally in revenues in Railtown comes in so rapid fire in the third and fourth quarters that the projectable revenue growth and the addressable market is so large that not only do investors like institutions see it, but people close to Railtown see it, investors and board members see it, and they say, no way, no how. We're not selling to Anthropic. We're going to stand alone. And then you do get these agreements, these licensing, these partnership. Remember, the strongest case to be made probably, and again, will adjust, but one of the strongest cases to be made about the upside in Railtown is that it's Switzerland. It's that it's agnostic to which data center it uses. It's agnostic about the Google silo, the Amazon silo, the SpaceX space. It's agnostic. So that puts it in a unique position as long as it stays that way. In other words, as long as it stays out of somebody's silo, it has more value. Will it be able to? I don't know. Sometimes when an offer gets big, it's hard to stay out. But I happen to agree with Ward. Railtown can, particularly if it JVs or just licenses or is in the white, a white product. It's underneath the product. For example, it's the Intel inside. It can go a long way in share price. Harbison, Ward, I sure like the way you think, sir. Chris Lecoisier, welcome, Chris. Thanks for looking into Next Trip. I hope you speak to the CEO, Bill Kirby, and the head of IR, Rich Marshall. I spoke briefly with Bill, but I've spoken a couple of times with Rich. I think I have I'm sure Rich will give me an interview. I think Bill will too. But I hammered, I don't know if hammered's the right way, but I was pretty hard on the Lynn deal. But you know what? There are some answers there. On the Lynn deal, I was told it's nothing but an expensive bridge loan. Company is moving to be cash positive. Well, I've got a couple of more things I want to ask, but my impression is the exact same. But I want to make sure. There are some distinct concessions that Lynn gave them that if the company can do what it's confident it's going to do, it's just credit card debt in that case. It's just credit card debt. And what I was convinced in the conversation I had with Bill, and I spoke to Bill, I think 2 years ago or 3 years, 2.5 years ago, maybe twice. And when, so I've followed it a long time. I've had my skepticism. I've had my negative response at $8. But the biggest thing that he got across to me, he's got deep pockets backing him, very deep pockets backing him. So I can't tell you right now because I really need to. I've done a lot of research and I need to sit down with a yellow pad of paper and really map out the 2 or 3 variables. But it's my opinion They may get into the months where they have to pay Lind Partners, but I think because of the way the note is written, that if revenue doesn't bail out the company, but bail out the contract, and I mean massive revenue, I think that the deep pockets will come in. And the obvious question is, well, why didn't they invest now? Very interesting answer I got. Very interesting answer. But I don't know why. I don't have any insight to the news. But he said if these big backers came in and financed the company now to the amount that Lind did in stock as opposed to debt, in stock, because that's how you would do it, equity. That's how they would do it. He said, could an attorney accuse me or them of investing on knowledge that on what the company was about to do? Because they do know what the company's about to do and they have their opinion. And I thought, wow, that's pretty interesting. So you're saying there's new, but no one told me what's coming up. I have no idea. I mean, I can guess what they think, and that's something I would like to have an interview, so maybe they can say something. But my impression is, and because I've spoken with him before, I don't think he's a bullshitter. My impression is he wanted to be very careful in selling stock at these levels to just one or two investors to avoid a later lawsuit that said, hey, why didn't you let everybody buy in? Because obviously they knew what was coming. Very interesting point. And I've been mulling that for about a week. The way they structured the deal with Lind Partners, and I've compared it to the Finger deal, and I've tried to compare it to some others. I still have some work to do. I like to pull out a pad of paper and collect everything I've put together and just work it out. And I haven't quite yet, but I'm very close to doing that. But I believe that they made changes in the Lind deal that allows them to pay back the note, and it's essentially becomes 28% debt, which is massive, frankly. But it's, if you combine the thought that they didn't want to issue shares and trigger some sort of future, I mean, I'm saying this dramatic part. He didn't say that. But I'm saying that it could lead to a lawsuit. He didn't say that, but I can put two and two together. That if you had one or two of these guys who already own 60% of the company, if you allow them to buy more stock down here, it can come back and boomerang on you if things get powerful quickly. Look, I also know that can be a come on, and that private placements happen all the time. I get that too. But they needed to raise significant money to fund this, for lack of a better word, marketing campaign. But it's more than that. It's going to bring, they think, a lot of revenue very quickly, or at least the ability to predict revenue. We'll see. I got more work to do, and I'm going to do my due diligence more. But I'm convinced that I'm supporting you, Chris. I'm convinced that Lind Partners deal does have a clear path. I don't agree with you that it's nothing but an expensive bridge loan, because I think there's real risks if they fail in what they're trying to do. But remember, they've been building to this crescendo for 2 or 3 years. Part of what I'm hearing right now, I heard, I think 2.5, 3 years ago. I'd have to check one of my notebooks when it was, or my emails. So I really, I went from being, uh, you know, negative as hell. How the F could you sign a deal with Lynn Partners? And I don't even want to hear it, to believing that there's a real opportunity. Not, it's all about probabilities, it's all about risk reward. But I think in that stock, I know what you told me, and I'm not willing to go quite that high because I don't know the metrics. But I really think there's a chance for, I would say 10 to 25x in the stock in return for the very obvious risk of any company taking a Lynn partnership deal. But the deal is different. It is different. And I want to analyze that more fully. And there's a way out of it too, which is money. So it's credit card debt. And the question becomes, what did they spend that debt on? And I think I'm going to find out, and if I get interviews, everybody will find out that what they spend it on is the things that matter, creating dramatic ramping in revenue and cash flow and profits. It's high margin stuff too. It's interesting. But I've got work to do. I don't know if I'll do it tonight, but maybe tomorrow morning, maybe tonight too. I don't know. But I agree with you, Chris. Now, the one thing I caution, and I said to them, I don't think news announcements and board appointments and revenue deals, it's not going to make the stock go up. The grinding of selling is there, and I wouldn't be shocked if the grinding gets the stock lower. However, if announcements are definitive projections and it brings in institutional buying, that's a different story. That's a much bigger and different story. But and also, if there's no toad, where's my picture of the toad? If there's no toad behind the deal, there's nobody committed to stealing the entire market cap. Anyway, Chris, I agree with you. I want to tighten down my reasoning better. I literally want to go buy a yellow pad and write everything down. But I have your degree of good impression. I do. Ward Richardson, Harbison, thank you. And the same to you as well. So Harbison said, Ward, I sure like the way you think, sir. Ward Richardson, I see $1 trillion company in the making here. See, and Ward isn't listening to me. Ward actually got here first, and Ward actually has expanded my understanding of what the upside is in Railtown. So, but let's get it to $25, which is in and of itself a big a big run, isn't it? Chris Laquassier, thanks, Bill. Appreciate your honesty as always. You are the most knowledgeable guy in the street. Well, there's rats on the west side, bed bugs uptown. I've been shattered. My life's in tatters. How does he get to the part about shuffling to the street? Dun to the beat. I'm going to bring some Puerto Rican girls around. They're just dying to meet you. Anyway, shuffling to the street. I don't know if I'm the most knowledgeable. But what I will tell you, Chris, is, and I was younger, and it's not youth, it's not sex, it's none of that. It's length of experience. And a lot of it, you've got to go through, you got to lose. And I think the number one thing on Wall Street is you've got to be clear-eyed. You've got to be clear-eyed. And you've got to say it as you see it. And anybody that wants a yes person, they're not going to keep their money, but you've got to say it. But you know what? You also have to be willing to listen. I went down, I was on a trip a few weeks ago. I'm very impressed by somebody because she's in the role of advising people and I think running a big firm, but she's willing to listen to deals, as they call them, or transactions, or as some call them, opportunities. That's what you have to do. So you can go in, and if you expect the other guy to listen to your cold, hard truth, you know what? When they come back with an answer that makes sense, you owe it to them to listen to. But the number one thing you've got to recognize investing is guys like Jeff Easton, they don't do anybody favors. That's hard money. It's all about money. To him, it's just money. And that's the same with Rubenstein and Kramer. And if I could think Wydell, if I could think of one of them that had a name like Smith or Jones, I'd tell you, but they don't. There are some names in there of I did see in one of the paperwork, there were some names from the Middle East. I can't remember any of them now. So it's not just one area, but the Middle East is another place. I wouldn't trust everything I heard out of financing out of the Middle East either. So you just gotta, anyway, you gotta go in to any situation and recognize the risks. But then it becomes, well, all right, you define the risks. And this is where I differ from a lot of people, is you got to define the upside. And if the upside is impressive and it's based on due diligence, just because it's high doesn't mean it's not going to happen. That's where I differ from a lot of people. A lot of people look at a stock and say, oh, it's 23 cents. How could it ever be $55? And they laugh. Or how could it ever be $240? And they ridicule. Well, that's all back-assward to me. The critical thing is you look at the addressable market, you look at in this case, the agentic AI is going to change the use of software and arguably expand revenues. And you look at all that and you reverse engineer and you come up with these gigantic numbers, you chop it and you come up with a new number that sees You risk that one, and you come up with another one, and you risk it. And you actually, and a year and a half ago, I was coming up with targets. For Railtown last June, and I would sit right over there, and I'd try to do the projections. I was coming up with targets in the range of $285, $350, $425 a share. I never mentioned, well, I mentioned them in passing sometimes, but I never made that my emphasis. I chopped those numbers. So if you have a 4.25, or if you have a 350, or you have a 285, and you take 10% of it, you're taking all that risk. You didn't make up that number. You got to that number by what's the addressable market? How much is 3% of that market? How many shares are outstanding? And you come up with these numbers that just overwhelm you. And then, of course, the multiples. So you chop, chop, chop. 10% of it gets you to $28. 20% of that number gets you to 50. I don't know. I think if you do your due diligence, and if the story merits high targets, you can't just look at the stock price and say, oh, it never happened. That doesn't happen. That's not how you make money. But having said that, you got to fully examine the risks and ask about them. And if the answers come back satisfactorily, doesn't mean all risk is gone. It just means that the probabilities of success go way in your favor. That's how I see it. So, Ward Richardson, William, keep up the good work. Real strong. Ward Richardson. By the way, what are we going to talk about for the next few weeks? Well, I got to finish this one thing here, and I'm debating finishing it tonight or not. Let me just look at it. I might be able to do it tonight. It's the Frenchman. And he just is such a sourpuss. But he's also fair. He's also fair. It is the Frenchman, though. Let me start and see if I can finish the Frenchman, Ward. And then we'll talk about other things. We can talk about war, children. Does it then go rape, murder? Is that the words to that song? All right, so this is the Frenchman. Let's try to get through it. And this is the last one on this subject. So I'll try to get through it tonight. See the question? Can you give me a primer on how and who and the mechanics of everything? All these questions in this microcap scheme. So this is the Frenchman, Claude, and he says, this is a big set of questions. So let me take them in the order the mechanics actually stack, and flag where the popular version of the story is right and where it's directionally right, but legally imprecise, and where, because I'm a Frenchman, where the evidence cuts the other way. I don't know. I shouldn't pick on Frenchmen because I'm probably part French. You'll want the imprecise parts labeled since that's your standard. Yeah, all right, your mama. My dad told me that we might be Huguenots, which runs afoul of being Catholic, but who knows? All right, let's keep going. What is actually selling in a $2 stock? There is no single HFT selling actor. There are 5 distinct populations, and conflating them is the most common analytical error in this space. Do you see why I hate this guy so much? He's always correcting me. But on the other hand, it's actually good to learn. So one of them are wholesalers and so-called internalizers. That's Citadel Securities, Virtue, Jane Street, G1X, 2 Sigma Securities. They buy retail order flow from Robinhood, Schwab, Rebull, and execute against it off exchange. In a microcap, they are usually not directional shorts. They're capturing the spread on segmented flow. Well, I think this whole thing, internalizer, is just another name for front running. But hey. Okay, and then another one is the registered market makers. There is no, I mean, they're registered as market makers, but the market makers don't exist anymore, in my opinion. So the other one is there's 5 distinct populations. Number 1, the wholesalers and the internalizers. Number 2 is the registered market makers, quoting on NASDAQ or in OTC Link. In an illiquid name, there may be 1 or 2 real market makers and a dozen nominal market makers who quote wide and away. Number 3, statistical latency prop firms. That's proprietary trading firms. Proprietary trading used to happen inside of the brokerage firms with compliance. Under Obama, they broke the banks up for FDIC purposes, and those risk desks went out and became hedge funds or prop firms. So statistical latency prop firms running cross-venue and ETF relative signals. In a $5 million float company, they're mostly not there. There's no capacity. Well, I wonder. Hedge desks for the paper. This is the one that matters and the one that people miss. When a company sells a convertible with a VWAP discount conversion feature, the holder is economically short from the moment of funding. That's true. Their hedging program is a mechanical, price-insensitive, volume proportional seller. It looks exactly like algorithmic predation, and it isn't a conspiracy. It's delta management disclosed in the 8K if you read the exhibit. Delta Dawn, what's that flower you got on? So it's delta management, they call it. And then the 5th thing is the company itself through ATM sales and the ATM sales agent, which is contractually instructed to sell as a percentage of daily volume. That's not stock, that's dollars. And so when you get promoters, you got to ask yourself, are they there to get the daily volume up so the company can issue shares? At least the company is getting most of the money directly in that case. I think they leave out a 6th, and 7th. The 6th is groups like the Toad who get head warning and they just cheat and they bribe and they do offshore payments, but you can't prove it. And I think also there's the aggressive day trading, swing trading desks and underfunded hotshots that join in. But anyway, let's go on with the Frenchman. The last two are the bulk of the persistent supply. So it's the hedge desk, it's Lynn Partners desks, maybe, and it's the company itself, maybe. I would add to it extra hedge funds with the goal of stealing the market cap. The last two are the bulk of the persistent supply in most sub $5 names. They are also the two you can document from filings, which is why they belong at the center of any piece. He always assumes I'm going to write something. I'm not sure I am. But that's the key. This guy, this AI, never, he's like an attorney, never speculates, never lets any information come in the thought process that can't be proven. Well, I submit myself to him because I think you have to. You have to listen to all sides, darn it. So here we go. Bona fide marketing, the load-bearing fiction. The legal term matters because it's the key to the locate exception. It's the key. The name is the key. Reg Show Rule 203B something 3 exempts a market maker, it exempts a market maker engaged in bona fide market making. It exempts them from the requirement to locate shares before selling short. The SEC has never defined it by rule. The SEC has only defined it by guidance. In the 2008 Reg Show adopting releases and staff facts is where you could find that guidance. The stated factors, continuous two-sided quotes at or near the market, a willingness to buy as well as to sell, assumption of real economic risk, and the operative one, the absence of a pattern of consistently selling without buying or of quoting on one side at prices unlikely to be reached. See, I think the attorneys help them wear this dress, but underneath the dress, they're the cowboys. So the test is behavioral and retrospective, not licensure. A firm that holds a market maker registration is not automatically bona fide, and the SEC said so explicitly, but nobody audits it in real time. There is no field on any form where a firm attests trade by trade that a particular short was bona fide. The exception is self-invoked and only tested if someone opens an investigation. In practice, a $4 million cap company never sees that happen. That's the honest version of your thesis. Not that the exception is illegitimate, but that it's an unpoliced self-certification in exactly the corner of the market with the least surveillance capacity. This is Secretary of Treasury Rubin and William Jefferson Clinton. The markets can police themselves. And then, of course, Republicans feel that way all the time. 2 documented cases you can use. All right, let's see what it says. The bloody anal retentive attorney. Okay, so you have SEC v. Citadel Securities in January of 2017. It was a $22.6 million settlement. The commission found that 2 of Citadel's algorithms handling retail orders in OT securities, the algorithms, I guess, were called fast fill and they were called slow fill, did not deliver the best prices Citadel had internally observed, contrary to what it told clients. OTC, retail flow, and pricing. But look at the settlement, $22.6 million. That's a small condominium for Ken Griffin. FINRA versus Citadel Securities in July of 2020. A $700,000 fine. That's a vacation for trading ahead of customers on OTC orders. I tell you they do it, but these AI says no, it's internalizing of orders. That one is literal front running, adjudicated, not alleged. Yeah, but it's a $700,000 fine. Front running by Citadel as a general claim is legally imprecise. See, he's an attorney, I guess. Payment for order flow and internalization are not front running. Well, of course they are, but you can't call it that. And saying so invites an easy rebuttal that lets the reader dismiss you as a loony. Why a stock that should trade by appointment gets continuous auction treatment? Because U.S. equity market structure, because the answer is because U.S. equity market structure has no tiering by liquidity. Reg NMS applies identically to Apple and to a $3 million cap NASDAQ capital market issue. It's the same continuous auction, same fragmentation across 16 plus exchanges and 30 plus ATSs, same off-exchange internalization, same sub-penny price improvement. Europe has SME growth markets with distinct rules. The United States dismantled its tiering. Do you think that was at the help of the big pools of money and with the attorneys? The regional exchanges, the third market, the OTCB, it was all dismantled. The tiering was dismantled without building a replacement. Do you think that was done with you in mind, or the toad, or Ken Griffin? The obvious fix, see, now this is why I like the Frenchman. He comes up with logical, and I agree with this. I've suggested this. The obvious fix, wider ticks for small caps, was actually tested. Bring back an 1/8 or a 32nd. The SEC tick size pilot was taken over by Bill Gates so that investors would no longer eat red meat. Is that what you're talking about? No. The SEC tick size pilot, October 2016, to September 2018, mandated by the Jobs Act, widened increments to 5 cents for 1,200 small caps. The result, spreads and trading costs went up. Okay. Liquidity did not improve, and the promised second order benefits, more market making and more research coverage, more IPOs did not appear. In 2 years, they knew all you had to do was ride out breakfast at the Bidens and go get your hedge funds and your Goldman Sachs and your revolving door into Congress and the SEC. 2 years isn't enough. Anyway, so they tried it for 2 years. Didn't work. So now they can say it doesn't work, so we can go back to stealing. That's an inconvenient empirical result, and you should know it. 2 years. It's not enough. All right, let's keep moving. The current direction is the opposite. The SEC's 2024 amendments cut the minimum tick to half a penny for tick-constrained stocks and cut the access fee from 30 mils to 10. I don't know what a mils is, 30 milliseconds to 10. So the DC Circuit Court upheld them because whoever the judge was certainly knew what she was talking about. But the SEC then delayed compliance to November of 2026, this year, and the CSA Zero have paused their harmonized Canadian rules to November of next year. Meanwhile, on June 11th, 2026, the SEC proposed rescinding Rule 611, the order protection rule, and the Rule 610E, the locked and crossed prohibition. Comments are due this month, August 17, 26. That would be the largest change to the equity market structure since Reg MS itself, and it shifts the entire burden onto broker-dealers' best execution obligations. For microcaps specifically, removing the trade-through anchor removes the one bright line rule that constrained where an off-exchange execution could print. It's going to allow the gray markets to trade above the bid or below the bid and the ask. That's what it sounds like to me. Do you think the rules are being changed to help you or Ken Griffin? I'll let you think about it. So where are the specialists, the research and the thundering herd? Where did they go? This is a chain of individually defensible reforms that collectively have destroyed the small cap ecosystem's economics. In 1975, before my time, but I think 1 year before the Starland Vocal Band's big hit, in 1975, fixed commissions were abolished. 1994, Christie and Schultz published the Odd Eighths study showing NASDAQ market makers avoiding odd eighth quotes. This leads to the SEC's 1996 21A report and the 1997 order handling rules, which forced limit order display and collapsed spreads. The year 2000, Reg FD ends selective disclosure, and with it, the informational edge that made small cap coverage worth funding. So firms and research analysts and institutions had an edge that made it worthwhile funding small cap. 2001 decimalization, the final blow to the spread economics. So that means the desks are gone, research is gone, market makers are gone, brokers are gone. 2002, Sarbanes-Oxley raises the fixed cost of being a small company and of being public. 2003, the Global Research Analyst Settlement, 10 firms, 1.4 billion, formal separation of research from banking. And then they make fun of research now because it has to be paid for. It used to be banking and research. If you were a company that went for banking, the research was thrown in for free. It used to be that way. Anyway, 10 firms, the formal separation of research from banking, plus 5 years of funded independent research. That funded ended in 2009 and was never renewed. So they take away research. Now, can I point out to you that I've said to you often, this was incrementally done over time? I think this lays out support for my argument. 2004, the specialist scandal. The SEC settled with 5 New York Stock Exchange specialist firms for $274 million for interpositioning and trading ahead. 2005 to 2007, Reg NMS and the New York Stock Exchange hybrid market. Specialists become designated market makers, an affirmative obligation role, stripped of the negative obligation and the information advantage that funded it. So the markets have changed. And I would remind you to be kind to people like Ham who've been gone and others. The markets have changed. We grew up in a completely different market. We were trained for a completely different market. The causal mechanism is simple and worth stated plainly. A quarter point spread on a $3 stock paid for an analyst and it paid for a retail sales force. A half-cent spread pays for a server. A half-cent spread pays for a server, a mechanical robot, a high-frequency trading server. The thundering herd wasn't killed by regulation hostile to retail. It was killed by regulation that made execution cheap. Nobody has ever answered the question of who funds coverage and distribution for a $40 million company in a world of 1-cent spreads and free trades. Exactly. The market's answer was paid promotion, which seems very logical, which is legal. It is legal. Paid promotion is legal. Section 17B of the Securities Act requires only disclosure of compensation, not absence of compensation. That's why an atrium style 51 buy/0 sell model can run in daylight with a paragraph at the bottom. It's the disclosure. The disclosure exists. The SEC and the OTC, the numbers here are stark and current. The SEC filed 456 enforcement actions in the full year of 2025, roughly 20% below the prior year. And the SEC initiated just 5 actions against public companies and subsidiaries in the first half of 26, the lowest opening half figure in at least 16 years. Per Cornerstone Research and the New York University's Pollock Center seed database. 3 actions against public companies have also been dismissed under the current administration, with no comparable dismissals in the prior 16 years. Market manipulation cases have held steady at about 10% of the docket, and a majority of those involve microcap fraud. So microcap manipulation is a stable share of a sharply shrinking pie. Chairman Atkins has framed this as recalibration. Quote, no more sort of gotcha types of things, no regulation through enforcement, unquote. And he disputes some of the statistics. On short side transparency, the picture is worse than most people realize. On December 3, 2025, the SEC extended relief such that January 28 becomes the first Rule 13F2 reporting period, with initial Form Show filings due February 14, 2028. Rule 10C1A securities lending reporting to FINRA is pushed to September 28th of 2028, and public dissemination of that data has been pushed to March 29, 2029. The Fifth Circuit remanded both rules to the SEC in August 25 to quantify their cumulative economic impact. The 2 Dodd-Frank mandated transparency rules on short positions and securities lending, adopted in October 23, will not produce public data until 2029, 16 years after the statutory mandate. 16 years after Dodd-Frank, adopted in 23, will not produce public data until 29. Who do you think the SEC works for? You? On the revolving door, a caution. The intuitive account is that staff often soften enforcement to protect future employers. The best empirical work cuts against it. Of course it does. It's paid for. Luca, Saru, and Trebi, 2014, studying SEC staff transitions, found no evidence, of quid pro quo, and some evidence that departing staff were more aggressive, consistent with a regulatory schooling or reputation building model. Okay, right. Other work finds the opposite for specific enforcement categories. It might be what it is structural capture, shared assumptions, shared vocabulary, asymmetric resources between a 4,000 person agency and the defense bar, not as personal corruption. The structural version is defensible. Well, I'm not saying that anybody is taking envelopes. I'm saying their motives lead that way, and it's rational. It's not that they're. I might have gone too far down. At least one issuer's July 29 424B5 discloses that the MVLS rule was automatically stayed on July 29, 26, pending commission review, and it's uncertain whether or when it will take effect. That's a Rule 431 petition triggered stay 7 days after approval. This is a real investor protection rationale and a real transfer of loss. A company delisted into the OTC under this rule faces a collapsed shareholder base. Many institutions and IRA custodians can't hold OTC. Precisely at the moment it most needs a bid. NASDAQ collects listing fees on the way up and the compliance revenue on the way down and bears none of the cost of the exit. Both things are true. I don't know why this popped up. The MVLS rule is the market value listed securities rule. And we went through that tomorrow. Oh, I see where it might pop up. I asked, is the NASDAQ still the jewel? It's becoming two businesses under one brand. NASDAQ is a global listing venue, and NASDAQ is a compliance toll booth for the bottom tier. The bottom tier is being actively cleared out. The sequence since 2020, automatic delisting at 10 cents for 10 days. That's probably where Finger is headed. January 25 amendments accelerate delisting after bid price deficiency, eliminating the automatic stay during appeals in certain cases, and restricting repeated reverse splits. March 2025 amendments requiring market value of unrestricted publicly held shares to be satisfied only with new offering proceeds. So, March of 25, the amendments requiring market value of unrestricted publicly held shares to be satisfied only with new offering proceeds. December 25, a rule letting NASDAQ deny an initial listing application even where the applicant meets stated requirements. And June 2026, that same rule with a 4 on it, allowing delisting after an SEC trading suspension. And then the big one. On July 22, 2026, the SEC approved SR NASDAQ 2026-004, a new continued listing requirement of $5 million in market value of listed securities across all three NASDAQ tiers with no cure period, meaning a company below $5 million MLVLS for 30 consecutive business days is immediately subject to a staff delisting determination. A hearing request does not stay the suspension. A hearings panel may grant up to 180 days, but the company must then demonstrate it qualifies as a new listing applicant, as if it were a new listing applicant. And initial listing on the capital markets requires 15 million of unrestricted public float, 3 times the maintenance threshold. NASDAQ's cited justification was the rise in non-compliant issuers from 2 to 140 to 122 and then 91 last year. Those are annually. Now, just to remind you, what I read out of order there is that when a company falls off NASDAQ to the OTC, all of a sudden retirement accounts can't hold it, and many institutions can't hold it. It feeds more selling. These are called positive feedback loops, but they're hellish. I really believe that all of this has been set up by attorneys and these big pool of funds and these in the dark funds and the so-called market makers. Somebody honest has to come and fix it. But until then, we have to know what we're up against. So that's why I'm going through this. Let's continue with the Frenchman. Toxic paper, why lawyers can build it and why usurious is the wrong word. See, he always corrects me. The architecture in order, Reg D 506BC or Section 4A2, private placement of a note with a conversion price set at a discount to a look-back VWAP. No registration required at issuance. Resale registration on Form S1 or Rule 144 after the holding period, taking back to the note's issuance dates. Then Rule 144 is 6 months. The shares emerge freely tradable. The ATM under Rule 415A4 needs an effective Form S3 shelf, and the quote baby shelf limit in General Instruction IB6 caps a company with under 75 million non-affiliate float at 1/3 of that float per 12 months. This is a real constraint, which is why sub $75 million companies pivot to registered directs, equity lines, and S1 shelves instead, and being screwed by. Anyway, let's keep it to myself. Number 4, Section 3810, court-approved settlement exchanges, debt converted to a stock via a fairness hearing or exempt from registration, immediately free trading. This is the purest end run in the toolkit, and it deserves its own piece. They assumes I'm going to write about it. Equity lines and purchase agreements. A commitment to buy at a formula price drawn at the company's option, which is how it's the CEO's fault framing gets constructed. Every draw is voluntary. Look, it's all clever attorneys. It's all clever attorneys. That's all it is. On usury, your instinct is legally correct more often than the industry admits. Wow. My friend, mon ami. In Adar Buys versus Gene Sis ID, New York Court Appeals 2021, the court held that New York's criminal usury cap applies to convertible notes, that the value of the conversion option counts toward the interest calculation, and that a usurious note is void, not merely reduce. That's a live weapon and it's underused. It's jurisdiction specific and doesn't reach every structure, but usurious in English, legalese on paper, that was my word, is not just rhetoric. One of the most important state high courts agreed. I think that's when the Kramers moved their offices next to Joe Theismann's out in Old Town Alexandria in Virginia. The other live theory is unregistered dealer status. The 11th Court affirmed in SEC v. Almagaby and SEC versus Keener 2024 that serial convertible note funders who buy notes, convert, and dump can be acting as unregistered dealers under Section 15A. That's the single most effective tool ever deployed against this business model, and it cuts against the SEC's entirely abandoned OTC claim. What's uncertain is whether the current commission continues to bring these cases. I don't know. The loans keep happening, but let's keep running it down. Why good news gets sold? Because in almost every case, the marginal seller into news spikes is identifiable in the filings, and it isn't a mystery algorithm. It can be the ATM sales agent like Roth, instructed to sell as a percentage of the average daily volume. That's in money. A volume spike is the only moment the company can raise meaningful cash. The convertible holder's edge, restruck at a new price, or it could be registered resale shares from a prior pipe, sitting on an effective S1, waiting for liquidity. Warrant holders with cashless exercise, legacy holders who've been underwater for years and treat any bid as an exit. The algos aren't causing this. They are detecting it and stepping aside, which widens spreads and accelerates it. That's the honest mechanism, and it's more damning than the conspiracy version because it means the company's own capital structure is the predator. It's a good point, which gives you, when a stock sells off on good news, name the seller. The 424B5 in the ATM prospectus supplement, the notes X4 or X10, the resale S1s, selling stockholder table, and the 13GA, you can read all those. See, they believe, and this Frenchman believes, that everything that's done is done within the law. I don't buy it. So what does actually create a sustained institutional bid in any story? There's three conditions, and the third one is one that everybody skips. One, mandate eligibility. So if an institution can buy, most institutional mandates have hard floors. Minimum market cap, minimum price, $5, which is also the Reg T marginability number, and many custodians threshold. Minimum ADV, so a position, that's average daily volume in dollars, so a position can be exited in N number of days. Exchange listing and audit quality. Below these floors, the stock is uninvestable, regardless of merit. So that's one thing against institutions. And I don't think we need to go through them again. But, it's liquidity, it's price. And many institutions cannot invest in those shares. This is the meaning of institutional cutoffs. It's a compliance manual, but it's also in their mandate. 2, a variance collapsing events, not good news. An event that narrows the distribution of outcomes. A drug approval these are reasons why institutions can bid. A drug approval with a label and a reimbursement pathway, not just a date. A contract with a named counterparty, stated dollar value, and stated term, filed as an exhibit, not an MOU, not a letter of intent, not a strategic partnership. Real. Audited revenue on the financial statements, not a press release. These are all good things. A resource statement or a feasibility study to a recognized standard. An asset sale that converts to cash on the balance sheet. So we've already gone through this in our Railtown work. Contracted, auditable ARR appearing on financial statements. And then number 3, the dilution machine has to be switched off. It has to be switched off. By the way, the one good thing about the Frenchman is he can read all the conversations I've ever had. The dilution machine has to be visibly switched off. Remember this. So if it's paid off, taken out of existence, no institution will build a position into an open ATM or an uncapped convertible because they would be funding the exit of the paper. That is the biggest reason catalysts fail. The news is real. The discounted cash flow improves, but it doesn't matter because supply at that price is unbounded. The way I put it is they can't define the denominator. A catalyst into unbounded supply is a gift to the note holder. It's a gift to the Kramers. It's a gift to, what's that one with Rubenstein? Yorkville. It's a gift. A catalyst into unbounded supply is a gift to the note holder, not to the shareholder. So you got to turn off the dilution machine. How you do that? You buy back the note in full. And I think you also need provable results, NAV or revenues, that are going to cause groups like the Toad not to keep selling. What an honest shareholder can do, blunt version, you cannot fix the market structure from the outside. We cannot fix the market structure from the outside. Any group that tries will exhaust itself. What you can change is issuer behavior. So things that work, you can demand books and records. It's cheap, it's statutory, and it produces the board minutes on how the toxic financing was approved. This is the highest yield tool available to retail, and almost nobody uses it. Rule 14A8 proposals and bylaw amendments restricting variable rate financings. I like that idea. Or requiring shareholder approval above a dilution threshold. Withhold vote campaigns against directors who approve the paper. Demand a published capital plan with stated maximum dilution and stated runway. Demand the promotional PR stop. the puff pieces. Every immaterial press release trains the market that news equals supply. I agree with this. If I had news, I'd keep it to myself if I didn't have to announce it. Lots of times you have to. Insider open market buying, verifiable, not grants, but verifiable on Form 4. Escalate to the states. NASAA members have become the more active cop on the microcap beat as the federal volume declines. State securities administrators can act where the SEC won't. Section 11, if there was a registered offering with a materially false statement, no scienter requirement, which is far lower than 10b-5. God, this is written for lawyers. Aren't you glad you're not a lawyer? Ugh. So, well-meaning groups destroy themselves. Standing is narrower than people think. There is no private right of action under Reg Show, none under the exchange listing rules. Blue chip stamps mean holders who didn't buy on or sell cannot bring 10b-5 claims. Yeah, those are always on my mind, the 10b-5 claim. The PSLRA's pleading standards are a wall. Standing exists, Section 11, Section 10b, derivative suits, Section 220, but it's channeled into narrow, expensive lanes, and understanding which lane you're in before you start matters considerably. Coordinated action creates legal exposure. If a shareholder group acts in concert and crosses 5% ownership, it's a group under Section 13D with filing obligations. And coordinated buying intended to affect price is squarely within Section 9A2 and Rule 10b-5. I'm glad we clarified that. The line between advocacy and manipulation is real. And the people most likely to push a group across it are the promoters who attach themselves to it. That's the failure mode that has killed every one of the retail activist campaigns in this sector. Two threads. The Rule 611 rescission comment deadline is August 17 this year, and whether the MVLS rules July 29 stay holds. I'll look into that, but let's move on. Can junior markets, my question is, by any stretch of one's imagination, be called fair? Do they receive adequate disclosure? Do they have price discovery? Is there a level playing field? Is there enforcement? Is there compliance, etc.? The short answer, of course, from the Frenchman is yes, they are entirely real. So that was my question. Are the markets real? And that's the problem. Fake is the wrong frame, and it's the frame that gets you called a cuckoo. Everything in the junior market is real. Real registration statements, real audits, real license intermediaries, real trades, real price formation, real disclosure, real fleecing, real steal. I'm adding that. It functions exactly as designed. What's false isn't the market, it's the description of the market which is sold to retail. What's false is the description of the market sold to retail. Swell. It's all swell. That's what my reaction is that all of this is swell. And it thrills me no end. It thrills me. Thrilled to meet you, Gloria. Normally one would have to go to the bowling alley to meet someone of your stature. This is not an invitation, Gloria. All right, let's go. Disclosure. This is the key thing. That's all that matters. Legally adequate, but informationally worthless. And somehow the courts go along with it. The legal standard is met almost universally. The 10K discloses the going concern. The 8K files the note as an exhibit. The 424B5 discloses the ATM. The REIT sale S1 lists the selling stockholders by name and by share count. I haven't noticed that always, but okay. The risk factors say in plain English that the offering may result in substantial dilution and that the price may decline. Nothing is hidden. I also don't completely agree with that. Now the foundation underneath it. The auditors serving microcaps are PCA OB triennially inspected firms. I guess that's triannually. And the inspection data is brutal. The aggregate deficiency rate at non-affiliated triennially inspected firms was 61% in 2024, improved from 67% in 2023. Among non-affiliated triennial firms inspected for the first time, just like a sturgeon inspected for the very first time. Inspectors found Part I.A deficiencies, wow, at 96%. A Part IA deficiency means the auditor did not obtain sufficient evidence to support the opinion it issued. So everything's on the up and up, obviously. For context, Big Four inspections in 21 ran about 16%. So the disclosure regime rests on audited financials, and for the tier of auditors that serve this market, roughly 6 auditors in 10 inspected audits did not support their own opinions. That's not an allegation. That's the regulator's own published number. Oh, I'm sure everything's illegal. Peachy King. And the regulator is being dismantled around it. The House passed in May of 25 to eliminate the PCAOB and fold it into the SEC because the SEC is so honest. It was stripped in the Senate on a Byrd Rule ruling. Erica Williams resigned as chair effective July 22nd, 25 at Atkins' request. A PCAOB finalized 37 PCAOB finalized 37 enforcement actions in 25, down 27% with monetary penalties of 17.6 million, a 50% decline. And more than 98% of that was finalized before Williams left. The SEC brought only 10 accounting and auditing actions in 25, the lowest in 9 years. Williams was replaced by acting chair George Botic, and then in February 26 by chair Demetrios Jim Logothetis. You know, I pointed out that the SEC doesn't care about the over-the-counter, and they pointed back to me, oh, yes, they do, but look at this. Look at this. Verdict. Adequate disclosure as a legal formality. Adequate disclosure fails as an information system. The disclosure exists, it is complete, is timely, and is unreliable at the audit layer and unread at the reader layer. Both failures are documented. How can you call it complete and unreliable at the audit layer? I think you've got too many attorneys, too many lawyers who are liars. Price discovery. I said it, does it happen? It's real and measuring something other than value. This point deserves more precision than it usually gets. Price discovery in a microcap works. It is efficiently and accurately discovering the marginal supply schedule. Senator, you told me they'd be decently treated. They have been decently treated. They've been decently rounded up, decently fed, and now they're decently shot. Price discovery in a microcap works. It is efficiently and accurately discovering the marginal supply schedule. When a name has a hedged convertible holder, an open ATM, and 40 million registered resale shares on an effective S1, the price is a near perfect real-time reading of where that supply clears. It is not a reading of enterprise value, and it was never going to be, because the quantity of stock available at any price is unbounded and endogenous to the price itself. Higher price, more ATM capacity. Lower price, more conversion shares. The supply curve slopes the wrong way, and we've gone through the pictures. So the market is doing genuine discovery of a genuine quantity. The failure is that investors believe they are observing a valuation signal when investors are actually observing a dilution schedule. So the verdict is Price discovery is functioning, but the output is systemically misread, including by the companies themselves, which is why boards conclude the market doesn't understand our story. When the market understands the capital structure perfectly, I actually agree with the attorney here, the solicitor. I think he is correct. Level playing field, is there one? No. And the securities laws never promise you a rose garden. Worth being precise here, but because this is where the argument goes soft. The federal securities laws are a disclosure regime, not a parity regime. They never promised retail and informational or a structural role equal footing. The federal securities laws promised that material information would be made public. Measured against that promise, the junior market roughly complies. Measured against the thing retail believes was promised, it fails completely. And if you add in the shadows and the illegal, it really fails. But you can't prove that stuff. Here's how it fails completely. The note holder knows the conversion schedule that they're on. You can derive it, but only by reading an exhibit most holders never open. I do, contrary to one Discord promoting guy saying what he says. The company knows its own at the money draw plan. You learn it in the next 10Q. The wholesaler sees the retail flow. They internalize it. They don't front run it, of course. You don't. The paid research shop discloses compensation under Section 17B in a footer. Well, we all know. Okay, we all know about it. Every one of these symmetries, every one of these asymmetries is legal, disclosed, and available. That's the uncomfortable finding. The playing field is tilted in daylight. No conspiracy is required. The stronger claim is that a disclosure regime is a wholly inadequate protective architecture when the disclosure is 300 pages. The reader is a retail holder with a $4,000 position, and the counterparty is a structured finance desk that reads it professionally. I agree with that. So the verdict is that it fails, but the merits of the regime's design. So is it a level playing field? So the verdict is it fails. But on the merits of the design, it's not a violation. So enforcement, this is the cleanest failure, and it's fully quantified. 5 enforcement actions against public companies in the first half of fiscal year 26, the lowest opening half in at least 16 years, plus 3 dismissals of public company actions under the current administration, with no comparable dismissals in the prior 16 years. The SEC's new enforcement director, Margaret Ryan, said in a February 11/26 speech that she is more concerned with quality and impact than with chasing numbers, attributing the stance to resource limitation. Swell. Layer on the transparency schedule from before. Form show short reporting deferred to a first filing in February 28. Securities lending reporting to FINRA deferred to September of 28, and public dissemination to March of 29. That is the entire case in two facts. Enforcement volume at a 16-year low, and the data that would enable third-party detection. How can you say that's full disclosure? Unavailable until the end of the decade. You don't need a theory. So the verdict on enforcement is it fails, and it fails against its own stated standard. Compliance near perfect, and that's the indictment. Junior issuers are formally highly compliant. They file on time, they obtain fairness opinions, they get shareholders' approval where NASDAQ Rule 5635 requires it. They put the risk factors in. They put the risk factors out. They turn it all around. Anyway, their counsel structures every financing to a defensible exemption. Reg D, then S1 resale, Section 3A10 fairness hearing, or an equity line drawn at the company's option. The system produces exemplary compliance, but it produces terrible outcomes simultaneously. Because compliance is defined procedure. I don't know why I can't pronounce anything. Compliance is defined procedurally. There is no rule anywhere that says a financing must be fair. There are rules about how it must be disclosed and approved. The one live exception worth watching is the unregistered dealer theory, which I think Mark Bazile's firm started. The 11th Circuit Almagarby and Keener decisions, I'm sorry, which finally attacked the conduct rather than the paperwork. Whether the current commission keeps bringing these in, I'd argue the single best leading indicator of whether anything changes at all. Verdict: compliance passes, but damningly. So is it real? I asked again. It's real the way a licensed casino is real. Real money, real rules, licensed operators, published odds, audited machines, and a house edge that is fully disclosed to anybody who reads the disclosure. Nobody at a casino is defrauded. The odds are on the wall. The fraud, if you want to locate it precisely, is not in the market's mechanics. It's in the gap between what the junior market is. It's a high cost, high failure, structurally adverse venue for financing companies. And here's a key thing: that cannot access anything better. And the other side of the gap is how this market is marketed to retail. It is marketed as a democratized on-ramp to the next great American company. That's how it's marketed. The SEC's disclosure regime is designed to close exactly that gap and that disclosure regime has failed. Not because the disclosures are absent, but because disclosure alone cannot close a gap that large. Oh, it's all lying. All right, so we have that. So here's the test that actually matters: capital formation. The junior markets exist to fund companies that can't get funded elsewhere. That's the whole justification for the reduced disclosure burden, the lower listing standards, the accredited investor exemptions. Does it work for a minority of issuers? Yes, it really does for a minority. Exploration geology, for example, oil and gas, mining, single asset biotech. I guess we might see that someday in national biosciences, and early stage tech get funded here and essentially nowhere else. And I would argue early stage tech would have applied maybe to finger if they followed through. Early stage tech probably applies to next trip, but certainly early stage tech is Railtown. So exploration, geology, single asset biotech, and early stage technology get funded here and essentially nowhere else. The counterfactual isn't a better capitalized microcap sector. It's no microcap sector. Junior mining in particular would simply cease to exist without the TSXV CSE flow through machinery, promotional excess and all. I agree with that. And it actually works in many cases. For the median issuer, though, the pipeline is fee extraction. NASDAQ's own filings cited non-compliant issuers rising from 2 and 21 to 140 and 23, 122 and 24, 91 and 25. And that's just the exchange listed tier, which is the good end of the NASDAQ. And imagine all the fees that Adina Friedman collects. If you want a testable standard for what real would require, I would propose 4. 1, audit reliability. I agree with him. A deficiency rate under 20% at the firm serving this tier, or a rule that issuers below some threshold must use annually inspected auditors. I agree 100%. 2, bounded dilution, mandatory disclosure of a single plain English number, maximum shares issuable under all outstanding instruments as a percentage of current shares out on the cover page, updated quarterly. This exists nowhere and would cost nothing. I agree. This is what I constantly talk about, the denominator. 3, supply transparency in real time. ATM draws disclosed daily, not quarterly. Conversion notices filed on receipt. You cannot have price discovery when the largest seller reports with a 45-day lag. I agree. And then 4, enforcement that arrives before the capital is gone. These all seem very reasonable, which requires the short and lending data, which is now scheduled for 29. Notice that 3 of 4 of these are pure disclosure fixes. The junior markets defenders say disclosure is the answer, and the specific disclosures that would actually matter are the ones that don't exist. That's very interesting. Is the CEO responsible to shareholders or to the company or to herself and to the board? The legal answer is narrow than either option, and the gap is where the whole problem lies. The duty runs to the corporation and its stockholders as a class. Under Delaware law, directors, since the well read court case Gantler v. Stevens, 2009, officers explicitly, including the CEO, owe fiduciary duties of care and loyalty to the corporation and its stockholders, not to the board. The board is not a beneficiary of anyone's duty. I never asked that, so let's skip it. But note the phrasing, the stockholders collectively as the residual claimant class. The CEO owes no fiduciary duty to you individually as a holder. None, none, none. There is no relationship between a public company CEO and a retail shareholder that the law recognizes as fiduciary. And there's a guy out there that calls CEOs and says, "Yeah, I'm speaking on behalf of the share." It just doesn't exist. This is why the intuitive complaint, quote, "she has a duty to me and she breached it," unquote, has no cause of action attached to it. Your remedies are a derivative claim on behalf of the corporation. And if there's any recovery, it goes to the corporation, not to you. Or a securities fraud claim under 10b-5, which is not a fiduciary theory at all. Duty, accountability, and incentive are three different channels. Your instinct that she's responsible to herself and the board is describing the second and third channels accurately, and people conflate them with the first because in a functioning company, all three align. The first is duty, and it runs to the corporation and stockholders. It's legal and enforceable in principle. The second is accountability, which runs to the board under DGCL section 141A. The business is managed by or under direction of the board, and the CEO is its agent. The board hires her, sets her comp, and fires her. And then 3 is incentive, runs to herself. Salary, option strike, continued employment, the next financing that funds another year of both. In a company with concentrated institutional ownership, an active analyst following, and a real market for corporate control, the accountability channel transmits the duty channel. The board answers to holders who can remove them. In a microcap with a dispersed retail base, no coverage, no institution above 5%, and a shareholder meeting where the broker non-votes decide the outcome, that transmission belt is severed. The duty still exists. Nothing carries the duty. A duty with no enforcement mechanism is simply a preference. Toxic financing is almost always legally unassailable. The business judgment rule presumes that a disinterested, independent board acting in good faith on an informed basis made a valid decision. And courts will not second guess the substance. A board authorizing a 40% discount convertible to fund 4 months of payroll is making a textbook business judgment. The alternative was Chapter 7. That's the outcome, and it's catastrophic for holders. Well, sorry, that the outcome of signing this convertible note is catastrophic for holders is irrelevant. The BGR, I don't know who that is, the business judgment rule, reviews the process, not the result. The rule breaks only in specific circumstances. Self-interest, if insiders participating in the financing or an affiliate of a director on the other side act in self-interest, then entire fairness. I don't know why they say entire. It must say enter fairness, and the burden flips. Bad faith, conscious disregard of a known duty. Okay, entrenchment, interfering with the stockholder franchise. Oversight failure. I'm going to not read it all out. If one of those 4 things, self-interest, bad faith, entrenchment, oversight failure, if you then say it's the CEO's fault, if those things aren't there, it's a moral claim, not a legal one. The duty shifts as the company approaches death. This matters enormously for a going concern microcap, and nobody in retail knows it. Under North American Catholic Educational Programming Foundation v. Giwala, 2007, directors of a company in the zone of insolvency continue to owe duties to the corporations. Creditors get no direct claim. Once the company is actually insolvent, creditors acquire a derivative standing, but the duty still runs to the corporation. And under Quadrant V Vertin, directors may still take risks that benefit equity protected by the BJR. Practically, as the balance sheet deteriorates, the residual claimant migrates from common equity to the note holder. A board acting properly to preserve enterprise value for the entity may take actions that are rationally hostile to the common shareholders. That's not a breach. That's the doctrine working. In Re Trados, Delaware chapter 2013, is the sharpest statement. Directors owe duties to the corporation for the benefit of residual claimants. And when Comin is out of the money, Comin's interests carry correspondingly less weight. This is the FAR bank test restated in fiduciary terms. Once the note holder is the residual claimant, the board's duty stops pointing at the shareholder. It's not a betrayal. It's a change in who is standing at the bottom of the waterfall. Retail investors are already swept away. So it's an amazing it's amazing theft. In the state of incorporation, whatever it is, largely determines the answer. Nevada, where a disproportionate share of microcaps incorporate, is a materially different regime. It provides that directors and officers are not individually liable unless the breach involved intentional misconduct, fraud, or a knowing violation of the law. That is a statutory floor far above Delaware's. It applies by default rather than by charter provision. And Nevada has codified the business judgment rule and permits consideration of non-shareholder constituencies. A Nevada incorporation in a microcap is in itself a disclosure. Delaware has moved toward Nevada. They have created statutory safe harbors under Section 144 for conflicted transactions involving directors, officers, and controlling stockholders, and amended Section 220 to require good faith, particularity, and a statutorily defined proper purpose for books and records demands. On February 27 this year, the Delaware Supreme Court upheld its constitutionality, and the amendments apply retroactively. So let's skip the correction there so we can move on. Texas completes the picture, having created its business courts in 24 and codified the BJR by statute. The D exit competition is a race in one direction, and its direction is less fiduciary exposure for management. Swell. I feel like all of this is swell. It's all swell for shareholders. I'm starting to feel that everything is just swell. Starting to feel really good about retail's chances in the modern market. So where duty still bites, insider participation in a dilutive financing. That's entire fairness. So that's very interesting. So that's why when Chris asked me, Bill Kirby answered, and that maybe his attorneys told him he can't have insider participation in dilutive financing. That's the entire fairness doctrine, I guess. I don't know. I'm not an attorney. If you have compensation increases contemporaneously with escalating dilution, it's not a breach standing alone, but the fact pattern survives a motion to dismiss. Financing timed around a contested vote, Blasius. A sale of control, Revlon, which is the one moment the duty becomes concretely enforceable and not coincidentally generates most of the microcap fiduciary litigation that exists. Section 11 for registered offering with a material misstatement, where there's no scienter requirement. and it makes everybody personally liable. I'm liable to get a little bit disappointed. A board that ran out of money after 3 years of prudent operation and took the only paper on offer was doing its job badly served. A board that took the first toxic note when non-dilutive alternatives existed, then took a second, then raised the CEO's salary, was choosing a business model. Both of those cases are usually protected by the business judgment rule. So I asked, which is preeminent, the duty to corporation or the duty to shareholders? And I think you can imagine the answer. Your instinct is right about the substance, but the history is off. And the correction strengthens your argument. The phrase isn't new, the switch inside it is. Quote, the corporation and its stockholders, unquote, is not a modern lawyerly hedge. It goes back at least to Guth v. Loft, Delaware, 1939. That's part of my nightly reading. The foundational corporate opportunity case, which uses that exact formulation. Why didn't I know? It has always been that phrasing. Nobody slipped the corporation in recently. So I've been wrong about that. I've said that for months that I thought they did, but I've been wrong. The answer to which is preeminent is this: the corporation is the beneficiary of the duty. Shareholders are preeminent only derivatively because they hold the residual claim. That's the whole thing. Directors owe the duty to the entity. Shareholders get the benefit of it because in a solvent company, they are the ones who capture every marginal dollar of enterprise value. Maximizing the corporation and maximizing shareholder value are the same operation. The two words in the phrase never needed to be ranked because they never diverged. They diverge in exactly one circumstance: when equity is out of the money, when shareholders are wiped out. So they quote another case. If you don't mind, I'm going to skip it. I'm going to skip legal reasoning. I'm just going to skip it because none of us are lawyers. So here it is restated. The corporation is preeminent. Shareholders are preeminent only whilst they are the residual claimants. Nothing has to change in the law for their preeminence to disappear. The capital structure changes it automatically. It's the financing itself that flips the switch. A board signs a note that puts the equity underwater. The note is now senior. Comin is out of the money. Every subsequent board decision is therefore evaluated in a regime where Comin's interests carry structurally less weight because Comin is no longer the residual claimant. The board did not have to argue for that shift, request it, or disclose it. It arrived as an automatic consequence of their boneheaded transaction. I added boneheaded. The financing manufactures the legal conditions under which its own successor is defensible. That's not a blurred line. It's a ratchet, and it only turns one way, which is also why the death spiral structure is so durable. Each round moves the company further into the territory where the board's fiduciary obligation to the common shareholder is the thinnest. And each round is individually protected by the business judgment rule as an entity preservation decision. By round 3, the argument that the board owed shareholders more has become close to legally incoherent. That's me. Through a process the shareholders funded. This just makes it depressing. It's just depressing. So the death spiral structure is durable because each round the board takes in the obligation to keep the entity going, it's protected by the business judgment rule for the entity. But as the crappy finances suck everything out of the company and destroy equity, there's nothing left for equity. Therefore, the board now owes equity nothing, and they owe the toxic lender everything. What? So I've been wrong in my summaries. So what makes it worth? Nevada made this statutory. Most microcaps aren't Delaware. So in Nevada, their rule expressly authorizes directors to consider the interest of employees, suppliers, creditors, customers, the community, and the interests of the corporation. And Nevada has no shareholder primacy override. Roughly 2/3 of states have constituency statutes. Delaware pointedly does not. So in the jurisdiction where most of these companies live, the corporation over shareholders framing isn't a contested doctrine at all. It's black letter statute. Entity preservation is nearly unfalsifiable as a defense. The board says without this note, the company dies and a dead company returns zero to everyone. That is almost always literally true. It is also the reasoning that justifies every round, including the ones with no plausible path to solvency, where the argument has teeth. Credit Lyonnaise protects preserving the entity. It does not protect preserving the payroll. So I asked, what are you extending the runway to? Because they had that in one of the answers. So what do you extend the runway to what? If the note buys 8 months to a readout, a closing, a permit, a delivery, in other words, a dated identifiable event that could plausibly restore value, that's entity preservation, and it's protected correctly. And I would argue that if there is a definable thing you're doing, maybe it makes sense. If there is no such event, the board is not preserving an enterprise. It is funding administrative continuation with fees to the lender and salary to management, while transferring the remaining value of the common to the note holder. That's the real fact pattern where Caremark's good faith prong and the duty of care on an informed basis actually have some bite. Conscious disregard of the knowledge that there is nothing on the other side of the financing. And that's what I came hard down on. Why not just end it while shareholders have a prayer? So this is your FAR bank test verbatim, wearing fiduciary clothes. The board minutes either identify the milestone the financing reaches or they don't. So that's under Caremark. We'll have to remember that. One asymmetry worth knowing. CEOs carry more exposure than directors on care claims, not less. There is some section has always allowed charter exculpation of directors for duty of care breaches. The amendment extended it to certain officers, but only for direct claims, not for derivative actions. So in a derivative suit alleging a CEO failed to inform herself before recommending the financing, she is not exculpated and the directors are. That gap is underused. I think I'm going to open a law firm. So I asked, is that duty to the corporation fulfilled by buying time of 6 months? Yet the ultimate doom is obvious. The short answer is yes under Delaware law. Buying 6 months can fulfill the duty even when doom is obvious. But the doctrine that permits it was built for a fact pattern that isn't ours. And that was Trenwick America Litigation Trust versus Ernst Young. Delaware rejected deepening insolvency as an independent cause of action. Strine held that directors of an insolvent company may in good faith pursue a strategy they believe will increase value, that insolvency does not switch off the business judgment rule. There is no this is what I said Martin Shen should have done. But there is no fiduciary duty to shut down. Isn't that unbelievable? A board is permitted to prefer the long shot to orderly liquidation. And the fact that the long shot missed and left creditors worse off does not create liability. The Third Circuit in Lafferty recognized deepening insolvency under Pennsylvania law. But Delaware and Nevada are firmly on the bad guy's side. So the legal answer to, quote, is a cellular boxed price better than facing the music early, unquote? The answer is the board is entitled to think so, and no court will make it justify that view. Swell. Aren't you getting excited? So 2 objections. Obvious doom is a hindsight construction. The blowjob rule is deliberately designed to exclude exactly this reasoning. Ex ante. Oh, God. All right, let's skip this. The summary, though, is the correct complaint is not about destruction. It's about the transfer of what's left to the note holder from the shareholders. But let's not get it bogged down in legal arguments I can't make sense of. Here's the argument that actually works. Trenwick was decided for a board making risky operating bets with a fixed capital structure. In that world, the doctrine makes sense because distressed equity is a call option on enterprise value. Out of the money, but with real option value that increases with time. Apply that to death value convertible and the logic inverts. So they argued that the concern was that shareholders want too much gambling, not too little, because they always win if it works. And they're going to lose anyway. So if you apply that logic to death spiral, the financing that buys 6 months converts at a discount to a declining price. Their shareholders per share residual claim is not merely at risk, it's being mechanically extinguished as a function of elapsed time, independent of whether the operating bet succeeds. So the option theoretic justification for letting boards gamble fails on its own terms. The shareholder isn't holding a lottery ticket whose value rises with time. The shareholder is holding a ticket that is being shredded to pay for the delay. Time is not the shareholder's friend in this structure. It is the lender's. All right, who is that? That is Chancellor Allen's footnote in Trenwick. Okay, we'll have to examine that in the future. Delaware's permission to gamble rests on an assumption that delay preserves optionality for the residual claimant, which this financing structure, the toxic financing, specifically violates. Trenwick has never been applied to a fact pattern where the instrument funding the delay guarantees the residual claimant's wipeout regardless of outcome. Nobody has litigated that way. I'm going to open up a shop. It's going to be called Bazile, Farrand, and Christensen, and I'm going to get that done. The incentive audit. You asked whether the incentives are misaligned. It's worse than misaligned. Run the ledger on who pays for the 6 months of financing. CEO, salary continues. Delay is not merely costless, it's the only source of income. Post-reverse split option repricing frequently improves her position. Directors, fees and D&O coverage continues. Filing bankruptcy is the single act most likely to generate litigation, naming them personally. Delay is personally free. The alternative is personally expensive. Lender profits directly from the delay. Each additional month is another conversion tranche at a fresh discount. The lender's returns are a function of elapsed time and price decline. It is long. The lender is long the company's deterioration. Counsel and the placement agent are paid per transaction. More rounds, more fees. Shareholder bears 100%. Shareholders bear 100% of the cost of delay, and shareholders hold none of the decision rights. I'm getting more and more excited. Every party with authority over the decision benefits from delay. The only party that pays for it has no vote. This is not marginal misalignment. It's a structure in which the fiduciary's self-interest and the beneficiary's interests are precisely opposed. And the business judgment rule sits on top saying the process was regular. There is a test that separates the two cases because sometimes the 6 months works, and that's true. Sometimes it does. A board that liquidated early before a closing has destroyed the value. Survivorship makes successes invisible. So that's a good point. Does the runway reach a dated identifiable event? And I agree. Sorry, I don't know why it's hard to pronounce things. I think I need to get a drink of water. My mouth is dry, but I want to keep going. So, does the runway reach a dated identifiable event? I think that's pretty good. 2, does the shareholder benefit if the milestone is hit? I think that's important. So the example here is if a company achieves its milestone and it comes out of this trouble with a $30 million enterprise value, but its shareholder account is $400 million, well, it didn't help anybody. It didn't help shareholders. So a delay that cannot benefit the residual claimant under any outcome is not a business judgment about the corporation's future. It's a decision about who gets paid during the liquidation. Unbelievable. Where liability could actually attach. So bad faith, officer care claims, bankruptcy avoidance actions, unregistered dealer. Let's get through them. I'm not going to read them because we're not attorneys here. But you can start to see that the odds against winning here are very difficult. And so people telling you it's fraud or there's going to be a squeeze, I don't know. You got to be careful. You got to know what's the value of what you have. And then judge it versus the risks. All right, we already went through that. Thank you. Did we go through this? Yes, we did. Thank you. Did we go through this? Yes, we did. Thank you. Did we go through this? Yep, that's the one we just finished. Okay, so every remedy that functions runs against the lender, not the board. The fiduciary architecture protects the CEO almost completely. What's left is securities and bankruptcy law aimed at the counterparty. Okay. I don't know how to improve on that, so we'll move on. What I asked, what is a negative obligation? You brought it up earlier. And what is scienter? So there's 4 items here that I asked. 1, negative obligation. The New York Stock Exchange specialist had 2 duties. The second one is the one that vanished without anyone noticing. So you had an affirmative obligation, which was to maintain a fair and orderly market. Buy when the public was selling, sell when the public was buying. Commit capital against the imbalance, keep price continuity. Everybody remembers that one. Negative obligation was to stand aside. The specialist was prohibited from dealing for his own account when the market didn't need him. If public buy and sell orders could meet each other, he was required to let those orders do so. And his proprietary trading was permitted only when it was reasonably necessary to maintain continuity and depth. He was a liquidity provider of last resort, not a participant. Where do you think Kenny G fits in this? The 2 were a bargain. The specialist got his book, time and place priority, and an information monopoly on the order flow. In exchange, he took the other side when nobody else would and stayed out when he wasn't needed. Both halves of this bargain compensated each other. Watch what happened to that bargain. In 2001, decimalization destroys the spread that funded the affirmative obligation. 2003-4, the interpositioning scandal. 5 specialist firms settled for $247 million for trading between matchable public orders. That is precisely a negative obligation violation, and it's the last time the concept was seriously enforced. 2007-8, specialists became DMMs. The affirmative obligation survives in attenuated form as quoting requirements. The negative obligation is not carried over, so Kenny G can always internalize orders. And here's the part that matters for your beat. Today's dominant liquidity provider in a microcap, the wholesaler internalizing retail flow, has neither obligation, no duty to quote, no duty to stand aside, no duty to stand there tomorrow. So the system kept the economics of the intermediary role, and deleted both duties that justified it. Bona fide market making is the vestigial stub of the affirmative obligation, self-certified and unaudited. The negative obligation has no successor concept at all. Nobody today is required to let your order meet another retail order without a professional in the middle. Dark pools. Unbelievable. So Kenny G has no obligations, but he can stick his nose in between the trades and internalize them, as they call it. The mental state for fraud liability is scienter. So scienter is the intent to deceive, manipulate, or defraud. Negligence is not enough. Carelessness is not enough. Being wrong is not enough. All right, let's skip that. It's just horrible how everything is stacked against. So registered offerings has no scienter requirement, strict liability for the issuer, a due diligence defense for directors and underwriters. It's easy. Section 17 requires only negligence, which the Securities Act require only negligence. I don't want to get in the legal law. I can't help you there. I can't think quickly enough. The Rule 611 rescission is this month, and Sidley calls it one of the most significant changes to U.S. equity market structure in 2 decades. Atkins framed it as reviewing unintended consequences that have hindered rather than enhanced the long-term growth of our markets. I don't know what it means. The formula spits revenue 50% to quotes, 50% to trades. If you don't mind, I'm going to move on. I don't think it has much to do with us. And the stay on the Small Public Company Coalition, that's July 29. I'm going to also skip that because he likes being an attorney and I don't get it. So the $5 million threshold was an amendment number 1 filed June 2026. The absence of a cure period and the immediate suspension, but expanded hearings panel authority. Even if a panel grants 180 days, the company must demonstrate it qualifies as a new listing applicant. That's 15 million versus 5. One advisory shop reports NASDAQ treated July 23, 26 as one of those 30 business day counts. If accurate, that clock was running for 6 days before the stay. Whether it resets, we don't know. The migration of corporate charters out of Delaware to Nevada and Texas. The trigger was a Delaware Chancery decision perceived as hostile to controllers and management. The competitive response was immediate. Texas stood up in specialized business courts September of 24 and codified the business judgment rule by statute in 25. Nevada was already there. And so Delaware has passed some stuff driving reincorporations to Texas and Nevada. Wow. I asked what D-exit is. That's what it was. Delaware exit. Large caps catching up to where micro caps have been for 30 years. Nevada has always been the microcap charter jurisdiction of choice for exactly the reason now attracting Tesla. Nothing is new. The competitive dynamic now runs one direction across all three jurisdictions simultaneously. Delaware's plaintiff sidebar was functionally the last common law check on microcap boards. Microcap boards, I'm sorry, I can't pronounce. The possibility of a chancery suit was priced in even where none was filed. So I don't know. Seems to me Delaware is chasing everyone to Nevada and Texas, but I can't tell if Delaware is also improving. So I said, is the y'all exchange going to fix any of this as compared to Wall Street? The short answer, no, not even a little. And that's not by accident. The Texas Stock Exchange is not competing in the section where our problems live, and it never claimed to. The y'all exchange, it's going to be more of the same, y'all. It's going to be the more of the same, y'all. Oh, wait a minute. No, 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 no. Yeah, I think it's this. It's Florence, y'all. It's Florence, y'all. All right, we'll get through these and then I'm going to say goodnight. So the Texas proposes a single tier, and we're not going to run through it all. So Texas, I was hoping would help us. They have an entry bar of 200 million. So it's not going to help microcaps. So it doesn't change off-exchange internalization of retail flow, and fragmentation increases. And there's nothing about market making, locate exemption, or short transparency. So the y'all exchange is here to the exchange was backed by BlackRock and Citadel. I'm not going to say anything because it'll only get me in trouble. The number of U.S. public companies has fallen by more than 45% in 25 years, and the cost of going and staying public is the driver. It's one of the reasons the stock market goes up so much. So the new exchange opened in Dallas, and the minimum ticket is 200 million. Let's just move on from that. Is Kenny G providing anything valuable to the United States, the world, in return for his quote unquote services? Citadel is the hedge fund. Citadel Securities is the wholesaler. The fund's social function is capital allocation. I'm not going to like this answer. So transaction costs collapse. Yeah, but you don't include the, you have free transaction costs to lose all your money. I don't want to get in this argument. I don't care anymore. Kenny G is a genius. Okay, so all the favorable literature about Citadel and the rest of them is about large liquid cap securities. In a $4 million company with a $200,000 daily notional, nobody is providing meaningful liquidity. There is no committed capital, no inventory risk of any consequence, no obligation to quote, and no negative obligation either. What happens there is spread capture and supply detection on a security in which the dominant seller is a hedged note holder. Calling that liquidity provision is a category error. All right, I can agree with that. Okay, I think we'll end on that last note. Let me see if there's any comments. I think the thing that comes across to me, and there's a lot of depth there on the legal cases and all that. To me, I think attorneys over time have created the playing field for the funds and the cheaters, as I see it. But I think the main thing all of us have to understand, you're not going to win here unless you do the due diligence, unless you trust management, unless it is a real company with a real strategy that's going to come out. And the toxic financing obliterates companies, obliterates them. So there has to be a plan to take that out. Okay. Ward Richardson. Oh, no, not the Frenchman. Anything but the Frenchman. I agree. Ward, William, I did not know you have some French in you. No wonder why you guys are at each other's throats. May the best man win. En garde, en garde. Yeah, exactly. I don't know. My dad, it may be. It may be. He was never sure. All I know that I have for sure, I don't know anything for sure. Hey, William D. Waters, I purchased the last couple of 1,000 shares this morning. 100K. Yay, 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 yay. Rah, rah. D. Waters, run deep. D. Waters, run deep. 100,000 even. Awesome. Awesome. Congratulations. That is a big bravo. It's Deschamps is here. Deschamps is here. The champ is here. Awesome. I'm so glad you did that. I'm really happy for you. Bravo, bravo, bravo. Bravissimo, bravissimo. No, bravo, bravo, bravissimo. Jack Hamilton. Congratulations, D. Waters. Nicely done. As other RT fans have said, Welcome to the 100K Club. Ward Richardson, D. Waters, congratulations. Well done. Yay, 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 yay. Ricky Brogan, D. Waters, congratulations. Ward Richardson, by the way, William, did you find Dr. Tom Core linked comment about Cinchi? I want you to read what the CEO had to say about joining the AIP. I did, and I took a picture of it, but I didn't get to it, and I'm not going to get to it tonight. But yeah, it's very exciting. Pizza rules. Checking in, still holding, stay strong. Thanks, William. Exactly. Good for you, and good for everybody here. It's 9:39. I haven't eaten. I'm gonna go try to make something to eat. But I thank everybody for signing in. I'm gonna try to keep you active and distracted. August is probably going to be quiet because it is Canada, but don't give up. There could be an uplift. I want to explore over this week. I'd like to see if I can get an interview with Corey. It doesn't look like it, but I'm going to try. I want to get an interview with that Total Metals, and I'm going to see if I can get an interview with Next Trip. And I'm also going to see, I've already reached out, but I'm going to see if I can get interviews with some of these other advisor type people that I have followed. I don't know if I can, but I'd like on political events, on oil, on gold, on mining. I'm going to see what I can do. And we try to keep us engaged. But with that, I wish everybody peace. Thank you for signing in. You're going to be happy that I finished now the examination across all the AI I want to listen to about what goes on in the junior markets. And the key thing I think I've taken away is the framework for the markets. There's nobody looking out for equity. I've said that all along for shareholders. And even when they come and tell me that I'm wrong, they then explain it where I'm right. But that doesn't mean that there aren't companies where we can make outsized returns. We just have to recognize we can't be distracted by the hot money boys into hopeless situations. We got to use our head. And there are companies that can get out. I like the three areas they said. Resources, which is energy and metals and et cetera. Technology, and biotech. Of course, biotech is an area where there's a lot of cheating too, but Ward Richardson, if I see a couple more disruptive software companies joining AIP, that's Railtown owns AIP, I would think Railtown is building a Canadian version of Microsoft. Wow, Ward. What if Railtown is going to get funding on this big, beautiful bill in Canada, the big, beautiful AI bill in Canada, and the roll-up of the AIP partners isn't going to have to be funded out of low-price shares, and maybe the whole thing acts as a conglomerate. Wow. You've got a good point. They could provide everything that that's a massive point. But I'm too tired to go on about it. So I'm going to say good night to everybody. Wish everybody peace. We'll talk tomorrow. We're going to stay busy as we wait for September. but things could happen more quickly. And there may be a couple of other trades we can do with, on the side. I don't want anything to distract you from your rail town. All right. Cheers, everyone. Sleep tight.